Cool. All right. Hey, everybody. Thanks for having us. Today, we're going to be talking to you guys about stablecoins, how they work, kind of give you an overview and a sense of the space. So stablecoins are a really big topic. There are now more stablecoins than ever. If you asked us about stablecoins 2 years ago, this talk would have been much shorter and a lot easier to understand. And unfortunately, or I guess fortunately for the space, there's been so much experimentation and so many different ideas that have sprung up in the stablecoin world that I think it's really useful to get a distillation of what stablecoins basically are, the basic designs that actually work, and how to analyze them and what to expect out of them. So my goal for this talk is not necessarily to get you guys, experts on the mechanics of any particular stablecoin, but rather to give you a kind of general understanding of how stablecoins work if they do work. And so if you want to dive deeper into how Basis works or how Tether works or how MakerDAO works, you at least have a framework for understanding them at a high level. So without further ado, let's start with first understanding what we mean when we talk about stablecoins. So I'll just click through for you. Yeah. So the idea of an economic analysis of money really started with Stanley Jevons in 1875 when he wrote a treatise called Money and the Mechanism of Exchange. And this was the first time that it was formalized that in order for something to be money, there are three properties that it must have. So the first property is that it must be a medium of exchange. So a medium of exchange, you've probably heard this term if you've been wandering around crypto for any time at all. And a medium of exchange basically means that this is something through which we can facilitate an exchange of goods. Okay? So in sort of the state of nature, right? In order for people to actually exchange value, they have to have a double coincidence of wants, meaning I have rice, you have cheese. I have to want your cheese in order for us to have a profitable trade. And if I don't want your cheese, even though you want my rice, tough shit. But if we have money, then in exchange, we can engage in that exchange without needing the exact coincidence of wants on both sides of that barter. So that's the first role that money must play. Second role is as a store of value. Store of value means what it sounds like. It means that there's value in this money that can be stored and retrieved later. Okay? So there are some things that are obviously bad stores of value, like perishable goods. Okay? Perishable goods don't really store value very well because let's say you bake a cake, okay? That cake might be really valuable for the first couple days, and then it immediately loses its value relative to a freshly baked cake. So now that said, there are many assets or many potential forms of money that are durable. So copper is durable, gold is durable, metal is durable, right? So it's not purely durability that you need in order for something to be a good store of value, but that's one of the things you'd want. And of course, you want this value when you retrieve it to be predictable, meaning that you should expect it to be relatively stable over time. Now, note this is not really a property of a commodity itself. This is a property of a market, right? Deciding how valuable this thing will be a year from now is not up to the thing in question. It's up to how people value it a year from now, right? So, for example, oil is oil, but because the relative value of oil changes depending on things that happen in the overall market, oil is not an ideal store of value because the value or the value of oil to market participants changes over time. So, and finally, it should be a unit of account. That's the third major function. And a unit of account simply means that it is something through which we measure value and most of the time denominate prices. So if you think about it, it's pretty clear that for most of the things I just described, cryptocurrencies are not actually money. Cryptocurrencies are not money because one, we don't really, we kind of use them sometimes as a medium of exchange, right? If you want to buy a CryptoKitty, okay, you need to use Ether as your medium of exchange. I guess there's a little bit of medium of exchange going on there. Store of value, well, these assets are really volatile, right? So, as of late, Bitcoin has been kind of stablecoin-ish for the last month or so, but chances are that's not going to last. And so in general, these things aren't great stores of value. It's not very predictable when you hold your Bitcoin a year from now. Is it going to be priced around 6,500? Hard to say, but history has not been very kind on that thesis. And then, of course, lastly is a unit of account. Of course not. Nobody denominates the price of anything in Bitcoin because Bitcoin is way too unstable to serve as a unit of account. So very often in economies that are hyperinflating, what you often see is that even though people in that economy are forced to pay in the local hyperinflating currency, they'll denominate prices in some other currency, which means that that hyperinflating currency has stopped serving as a unit of account. So now, why do we care about stablecoins? Well, basically because we're kind of still attached to this idea that we want to create cryptographic money. And it's clear that most crypto is too volatile for actual monetary use, right? You cannot be a unit of account. You cannot be a store of value if you are too volatile. And imagine putting your life savings into crypto, right? As much as people kind of bang the drum of rah rah, crypto anarchy, whatever, people don't put their life savings in crypto. They put their investment portfolio in crypto. And that's the way that they think about it, right? If there's money you don't want to lose, people tell you, don't put it in crypto, right? Secondly, you wouldn't want to price goods in crypto. It's too volatile. And the other thing is that contracts that last over time, so we talk a lot about smart contracts, especially in Ethereum and other smart contract platforms, they require price stability. So for example, let's say that you want to pay somebody a salary over time. You're not going to denominate that salary in Bitcoin. Otherwise, 5 years from now, you're going to be paying them more than the CEO of Goldman Sachs, right? Or if you want to give somebody a loan, and that loan, what they have to pay you back, potentially 10x's next year, right? That's not really, that's bad. Prediction markets, derivatives, a lot of things require some price stability in the collateral for that contract. So today, why do we want stablecoins today? Well, in this, these are all kind of lofty future goals, right? Someday we'll have salaries, or someday we'll have loans denominated in crypto. Clearly, today we don't have that. So today, why does anybody care about stablecoins? Well, you guys might already know there's a lot of demand for stablecoins today, and the primary reason for that is that it helps you with the one primary killer app of crypto today, which is trading. So how do stablecoins help with trading? Well, they allow you to trade crypto without touching fiat. There's a little bit of regulatory arbitrage that goes into wanting to use crypto instead of just using fiat or using the US dollar. But also in that it consolidates liquidity across order books. Okay? So just to kind of give you a visual example of why this is true, right now imagine that this is an exchange. You've got all these different assets on it, right? Let's say imagine this is Coinbase, okay? And all of these exchanges have trading pairs with each other, or sorry, all of these assets have trading pairs with each other. So that means that liquidity, or the ability to sell one asset for another, is basically kind of smeared over all of these different pairs. Okay? However, if you put a stablecoin in the middle, then now suddenly every single asset trades to the stablecoin, and the stablecoin trades to every single cryptocurrency. Right? And this is actually what you see when you go to Binance or other crypto-only exchanges. Part of what the benefit they get from a stablecoin is that it becomes the natural reserve currency for a trading pair. And this, for trading, this is a very good thing. So, we want to create a type of crypto-based money that is pegged to the US dollar, or pegged to some stable asset. Usually it's the US dollar. This sounds maybe a little bit too good to be true. And if you have that intuition, that is a good intuition. You should feel that. Now, a stablecoin, at the end of the day, is just a price peg, right? I issue a currency, and I say this currency should each be worth $1 US. Okay? Now, is that a thing? Can we do that? You should be skeptical here, because can you really just decide on the price of an asset? Can you just say by fiat, yes, this is worth $1 each, have at it? Well, not really, right? It's up to the market to decide what an asset is priced at. So if you are claiming that instead of the market pricing you, you are pricing the asset directly and the market has to do what you say, right? That sounds like kind of backwards. That's not really how markets work. It's not really how prices work. So now, if you look through history at price pegs, many price pegs in history have failed, and very famously so for many of them. So some examples are Mexican peso in '94, the Russian ruble in 1998, British pound, if you guys have heard of the George Soros attack, or Black Wednesday, when George Soros broke the Bank of England. These are all examples of currency pegs that failed fairly catastrophically for all the people involved, including the citizens of their economies. But at the same time, there are some pegs that have worked fine. So there's I don't know why there's a link in this. You can't click on it. But if you go on Wikipedia and just type this in, you will find a list of all of the countries that currently are maintaining price pegs. So most of them are pegged to the US dollar. Some of them are pegged against the ruble if they're very close to Russia, or whatever other local superpowers that have stronger economies, price pegs are not uncommon. So, are there any pegs that have worked indefinitely? No, of course not. No. Every peg in history that has been tried eventually at some point failed or is continuing to run but has not been running for that long, right? So what does that tell you about the ability to peg things? It might tell you that, well, it's impossible. Pegs don't work. Now, I don't think that's quite the correct way to analyze a peg. In some sense, that's true, but I think it's a little bit more nuanced than that. Ultimately, pegs hold under some bounds of market conditions. Okay? So if things are really, really bad, the peg might break. If things are really, really good, you might have to exert a bunch of work to push it back down to that price range. But basically, the way to think about a peg is that pegs work so long as certain things happen or certain things don't happen. And if basically a currency falls outside of the bounds of the market conditions the peg can sustain, then the peg will break. And so long as it stays within that bounds, you're fine. And many pegs have been sustained for a very, very long time, such as the gold standard, which was a peg. Bretton Woods was basically a massive peg maintained by a bunch of major world powers against gold. So if you think about pegs this way, then it makes sense to analyze pegs in terms of what are the bounds on stability that the pegging mechanism offers. So to be as discrete as possible about this, some of the things that we're going to try to look at for these different mechanisms for stablecoins are how much downward volatility can the peg withstand, right? If the underlying drops 50%, if it drops 75%, can the peg still hold, right? And now, upward volatility is easy for almost every peg, right? Upward volatility, everybody has a way of like, okay, if this peg is overvalued, what do we do? Well, we print more. That's almost always the answer. Now, how collateral efficient is the peg? Meaning, how much money does it cost for you to issue this amount of this pegged asset? If the peg is very inefficient with respect to collateral, meaning you need a ton of collateral standing behind that peg, that's not great, right? We'd like to avoid that just because it makes it hard to have a really, really large supply because you need even larger collateral in order to be behind a supply of that stablecoin. Now, how easy is it to analyze the bands of behavior in which the peg is safe, right? So we might say, hypothetically, yeah, there's some bounds of behavior within which the peg is safe, but nobody really knows what it is. If that's true, that's bad, because it's much harder for people to behave rationally in determining when the peg is safe. If the peg is actually safe, but people think it's not safe because they have no idea what are actually the bounds of safety, that might trigger a market panic. And a market panic might push it outside the realms of safety, right? So it's very unlikely that the asset is unsafe, but people are so convinced it's safe they push it back in. Much more likely the asset's safe, but people are convinced it's unsafe and they push it out. So how transparently, another way of saying this, how transparently can people observe the true market conditions underlying that coin? So this is the framework through which we'll look at stablecoins. And we're going to look at the three major designs by which people implement stablecoins. So this is a very famous triangle made by a very famous person. This triangle basically describes the three different types of stablecoins. And there are logos, which some of you might be familiar with, embodying the sort of canonical implementation of each of these types. So the three types are fiat-collateralized, crypto-collateralized, and growth-collateralized. Okay, and we'll look at each of them in turn. So the simplest to understand, and the place where we're going to start, is with fiat-collateralized stablecoins. And this is also the largest by market cap, right? So how many people are familiar with Tether? OK, cool. So not everybody, that's OK. We're going to talk about how Tether and other coins like it fundamentally work under the hood. So this is basically the simplest thing you could possibly think of. Okay, if I just walked out to a random person on the street and asked them, hey, implement a stablecoin, what do you think they would do? They would do this. Okay, so what they do is they grab a bunch of US dollars, they'd shove it in a bank, and then they'd issue tokens on the blockchain saying, hey, I have $1,000 in this bank, I issue 1,000 coins of dollar coin, okay? And basically, you can go trade those dollar coins, do whatever you want. And whenever you want to redeem your dollar coins, you send them to me, I write you a check, or I send you a bank wire for the number of dollar coins that you send back to me, and there's some mechanism to burn coins that you want to redeem, okay? That's it. That's the whole idea. Done. Tether, TrueUSD, that's it. That's what all of them do, okay? So voila, you have a stablecoin, right? this should be, I mean, if you think about it, this stablecoin is basically just a digital representation of a dollar bill, right? It's literally just, look, I have assets in a bank, I have these stablecoins. They should each represent a blockchainified version of one of these dollar bills in this bank, right? Cool. So there have been a lot of historic predecessors to systems like this. So there's eGold, which was collateralized by gold, Liberty Reserve, which was US dollars, which famously got taken down in the 90s, NetTeller, WebMoney. Actually, I think it was the 90s, maybe early 2000s. And so, this might seem kind of obvious, but it's worth asking the question, why should this asset trade at $1? Well, this asset should trade at $1 because, fundamentally, if the asset is mispriced, somebody can arbitrage it by just redeeming and then pocketing the difference, right? So if it trades at too high, then the issuer could just be, if it trades too low, the issuer could say, well, I know the dollars are there, so I'm just going to buy them up in the open market and redeem them directly myself. Or if it trades too low, then anybody who wants to just buy the coins low on the open market and redeem them themselves, they make money, right? Yes?
Question, who converts the tokens back at 101?
It depends. The systems work differently. So in Tether, you have to have a direct relationship with the Tether Corporation. With TrueUSD, it's like the trust that underlies all this stuff. I don't know. It sort of depends, right? Let's abstract that away for the moment. But in general, it's usually complicated from a regulatory perspective to establish those banking relationships. So if you think about it, this is kind of analogous to the same company being listed on two different exchanges, right? If you have the same company listed on two different exchanges, they should trade at the same price. Why should they trade at the same price? Well, because if they don't, somebody can arbitrage it, right? If they don't trade at the same price, somebody will buy it on one exchange and then go sell it on the other one, right? That's why it should trade at the same price. Sometimes there are market mispricings, right? Sometimes one exchange trades lower or higher than another because there's some problem with the exchange or like there's some suspicion about something or whatever, right? But usually over time, assuming that the market's normalized, that goes back to being the same price on both exchanges. Yeah.
So I guess historically, why were some of these places shut down? And I guess from the incentive of someone opening up a stablecoin that's backed to fiat, like why would they do that? What's in it for them?
Yeah. So there are two kind of questions in there. So one is, so eGold and Liberty Reserve, very famous predecessors to cryptocurrencies that were shut down and all of the founders thrown in prison. Okay. So it was not a great ending for the people involved with the first stablecoins. And actually, Satoshi Nakamoto makes particular reference to both eGold and Liberty Reserve when he describes, the way that he wants to go about building Bitcoin. So he was very much aware of the history before launching Bitcoin as a, potentially something that would put him on a government's radar. They were shut down largely because they had almost no AML or KYC, basically meaning that all you needed to do to set up an account on one of these exchanges was to have an email address and a name. Okay, so that's not great. That's pretty bad because basically there was a lot of black market activity that was done on Liberty Reserve and eGold, a lot of money laundering, a lot of just really, really shady stuff back in the early internet that was taking place almost entirely mediated through these two websites, and they basically didn't even try to beat any of it down. And they sort of were aware this was happening and were profiting very much from it. Now, if you are, let's say, the issuer, so let's see some of the examples. So these are some of the current issuers of fiat-collateralized stablecoins. So Tether, Gemini Dollar, Circle USDC, TrueUSD. These are all, and then there's Digix, which is it's actually gold collateralized, so not the US dollar, but back to an ounce of gold or whatever it is. So how do they make money? Why do they do this? Well, generally what they'll do is they'll charge you some small percentage when you want to send them new money to issue on the blockchain. Or when you want to redeem, they'll charge some small percent on the way out. So that's how these guys generally make money. So if you incorporate all of that in, then it's kind of like, well, should it really trade at $1? Shouldn't it trade at like a slight discount to the dollar? It doesn't. I don't know why. Markets are weird. Yes?
Do you have some sort of transparency index or ranking for how transparent the people creating each of these stablecoins are?
I do not. Other people do. Well, I don't know that anyone has like a rigorous one. But I'd say this is sort of like in reverse order, where Tether I think is I mean we have a slide. Here's yeah. So the way in which these differ is their strictness in terms of KYC and AML, and in the degree of like how credible are the teams, how highly audited or regulated are they. So Tether, most well known, has $2.2 billion market cap, is the largest stablecoin by orders of magnitude right now. And of course, there's really good news about Tether. So people love Tether for some reason, even though it's kind of a dumpster fire. But it's the most widely used stablecoin in the world. Yeah, I wouldn't recommend keeping your money there. Yeah.
Actually, wouldn't you say that the main reason that Tether got so popular was to avoid withdrawing money to avoid getting taxed?
I mean, you could argue that for any crypto, right? I mean, so most of the other stablecoins, although they have stricter AML and KYC on issuance and redemption, most of them do not require KYC for every address that holds the crypto. So, I mean, fundamentally, if you want to evade taxes through crypto, Tether is not necessary. You can just use Bitcoin. You can use anything you want, right?
Oh no, I don't mean evade taxation, but every time you say sell Bitcoin,
Hmm.
you sell it. If you're buying dollars, you should pay taxes on it.
Oh yes. So if you have like
Buying dollars,
like-kind
buying
exchanges, yeah.
dollars,
Right.
whatever.
So this is sort of
You
a
could argue, oh, I'm not going to have to pay taxes.
exactly. So in the U.S. that doesn't work, unfortunately, because
Every exchange of one digital currency to another digital currency incurs your tax as well.
yes, in the U.S. That's not true in every jurisdiction. So in some jurisdictions, Tether allows you that tax arbitrage. In the U.S., it technically should not. But the percentage of crypto people in the U.S. who pay their taxes is also very low. So I don't know. Like again, you don't need Tether. You don't need Tether to evade taxes. Yes.
Can you explain anything about like wash trading with Tether and like that's how they to maintain the price? I hear a lot about it, but I don't really understand.
Yeah. So unfortunately, I'm going to dodge that question a little bit, just because one, it's not my area of expertise, and second, I don't think it has a lot to do with Tether and how it works. It's more just a theory that Bitfinex prints Tether at convenient times to try to wash trade and push up the price of Bitcoin because, for some reason. I don't want to weigh in on conspiracy theories because I think there's not a lot of direct evidence for that. And clearly there's a lot of manipulation that happens in crypto. That said, the whole point of manipulation is that it's hard to point out, right? Because if it was easy to point out and actually know for certainty that manipulation was happening, then nobody would use your exchange and or the principals would go to jail or whatever. So there's no hard proof, but it's it's very well known that there's a lot of spoofing and wash trading and all sorts of stuff that goes on crypto exchanges. Much of it is facilitated by Tether, but if there was some other reserve currency that wasn't Tether, that would be the one we'd say everyone's wash trading with, right? So I don't know that it has that much to do with Tether, so much as it's simply the fact that this is the dominant reserve currency for trading, right? Yeah, in the back.
Where exactly is Tether host money right now? What's its jurisdiction? What kind of bank does it use? Is it through the high?
Does Tether use?
Yes.
So they were previously with Noble Bank, which is in Puerto Rico. They recently there's been claims that they moved to where was the place? HSBC.
I think that was the rumor.
Okay, yeah, whatever. They're rumors. Nobody knows. I don't know. Like,
What's the reason behind up to now? The case for 2 years still the same.
I'm sorry. Can you say it a little bit louder?
What's the reason behind by hiding the fact what bank do they use as a host bank?
Why are they hiding the bank they're using? Well, okay. The answer is that they're
Coins do not hide like a circle or like.
Yeah. So ultimately, the reality is for Tether. Again, I don't want to speculate too much about why Tether's doing what they're doing. Very clearly in the past, Tether, was founded basically after the Bitfinex hack in 2016. I want to say 2017, whatever. And essentially, it's very likely that basically Tether has kind of a shady background. They've cleaned up their act significantly, but regulators are not super happy with Tether, and it's very clear that there have been a lot of investigations into Tether that have been thwarted by Tether secrecy around who their banking partners are, and Tether's constantly had to move from bank to bank in order to maintain banking relationships because naturally nobody wants to bank you if they think the U.S. government is after you. So Tether's kind of a shit show in a lot of different ways. I'm not an expert on Tether, so I'm not gonna claim to know where they are right now or what they're thinking. But it's quite likely that 2 years from now we won't be using Tether anymore. So that's all I'll say in that regard. Yeah.
You also mentioned Digix, which is paid by gold. How does the redemption happen?
That I don't know. I don't know the mechanics for Digix. I don't want to speculate, but I would assume it's kind of analogous to what happens with with Tether. Yes?
Where do you think the regulatory issue happens? Is it only when you on-ramp and off-ramp with fiat, it will create that problem?
Yeah, so if you look at the newer regulated stablecoins like Gemini Dollar, right? So Gemini Dollar, it says that yes, we only do KYC and AML on the on-ramps and off-ramps. However, we also monitor the blockchain. And if we see that anyone's up to no good, we reserve the right to be able to disable their accounts and basically freeze their assets and conduct an investigation of some kind. Okay? This is the kind of thing you have to do if you want to be a financial intermediary in the United States. Tether's not doing that. Tether's not, they're like, why would we ever do that?
Digix can avoid that problem because it's not dealing with fiat?
That's correct. That's correct. Digix has a different regulatory framework because it's collateralized with gold as opposed to with fiat currencies. Again, I'm not an expert on this, but that is my understanding. Cool. OK, we got another one in the back.
Yeah, isn't there a reason why like fiat-based, let's say Bitcoin currency right now has a bigger market cap than decentralized MakerDAO?
I'm sorry, what is the reason?
The reason behind the fiat-based stablecoins like Tether, USD,
Yeah.
Gemini, GUSD, even Digix has a bigger market cap than let's say MakerDAO.
So the question is why?
Yes.
Yes, we will get to that when we discuss the crypto-collateralized stablecoins. So I'll hold off on that question. Yes.
This is a little bit of a complex question. Every bank in the U.S. is regulated by the OCC,
Mm-hmm.
and that gives consumers some level of assurity
Mm-hmm.
that those transactions are actually going to be, they're going to happen, and there is a fact that if the institution doesn't perform, the OCC will step in and perform based upon insurance and all of those kinds of things.
Yeah.
As you monetize money and the exchange of value,
Hmm.
two items. One is there's no one that I'm going to trust that has the ability both monetarily and power-wise, which means an army and so forth, to step in and say you will do this transaction or
Yeah.
we're going to shut you down.
Right.
The thing with law.
That's right.
And will the government ever give up control of currency? Because it is a power, right?
That's true.
And if I can't control my currency, or I let that currency be replaced or pegged to something else,
Yeah,
then that power goes away, right?
that's true.
And the government then says, do I exist or don't I exist? I mean, that's a big, major piece of it. So overall, as much as we would like to have cryptocurrency and so forth, at some point when it becomes something that's a pain in the neck for the government,
Mm-hmm.
they're just going to come in and say, you can't do this. And by the way, we'll just issue digital dollars, which we literally have, right?
Right.
The Fed approves its own budget
Mm-hmm.
and just says, okay, I'm going to wire in money. They're not moving gold or
Right.
dollar bills or whatever, right?
Right.
I mean, they set their own budget each year, and the Fed basically funds, moves a couple of electrons over and says, I got an extra $1 billion to run this year, or whatever
Yep.
the budget is each year.
Yeah. Well, you're absolutely right in the fundamental point that fiat collateralized coins are basically isomorphic to the U.S. dollar, like a digital U.S. dollar, right? So if you think about it, if the U.S. inflates the supply of U.S. dollars and the U.S. value of the U.S. dollar goes down, that will be reflected in every fiat collateralized stablecoin, right? Like it serves the exact same purpose. And for most of the more regulated stablecoins, they even have the same fundamental model where if a US regulator shows up on Gemini's doorstep and says, hey, this person is a terrorist, shut down their account, they'll do it like that, right? So right now, I think for the fiat collateralized stablecoins that are going to be overtaking Tether most likely in the not too far future, that they are essentially a continuation of the normal economic model of a regulated bank, right? That's one of the criticisms of fiat collateralized stablecoins. And I think it's a fair one, and it's one that to keep in mind as when considering how well can this kind of stablecoin sustain the kind of future we want within crypto. Now, your point about will governments allow this to happen? I think it's a much larger and wider question than I can probably answer today. So I'll take that as a comment, and I think we can maybe address that in our sort of fireside chat thing afterwards.
And also about crypto-collateralized.
Yeah, and the dynamics of crypto-collateralized coins. So let me go ahead and just wrap this up here. So let's just analyze what do we think of this scheme of fiat-collateralized stablecoins, right? It's really fucking simple, and that's a virtue. That is a tremendous virtue, especially in the world of crypto, where everything's complicated and things break and get hacked all the time. Okay, a fiat-collateralized stablecoin is awesome because it's just really simple to understand, and it's really simple to understand how and when it breaks. And even if it gets hacked, guess what? People aren't hacking your bank, right? They're hacking the blockchain. So you can't get hacked and all the money gets thrown out. You get hacked and the blockchain has some weird stuff on it. And then Tether actually got hacked for $30 million sometime last year. And what did they do? Well, they just said, well, that $30 million doesn't count anymore, right? Done. Hack solved, right? That's pretty good. It's inelegant, but it works. So now, of course, the downside of this is that it's completely centralized, right? It is dependent on the solvency and honesty of one party, and of course, for the government to not go after that party and decide they don't like that party anymore. So that also means that most of the time, or at least much of the time, you don't have a lot of transparency, unless the issuer is somebody who's by default going to be very transparent. But if they're being, if they're under the thumb of regulators, then they're only going to be as transparent as their regulators allow them to be. So this can lead to a lot of market scares, such as what happened recently with Tether, if you guys were following prices in the last week, where Tether, for the first time in a very, very long time, unpegged from $1 and was trading at the bottom about 93 cents. Just because of fears that Tether might have been insolvent, or they might have lost their banking relationship, or that something might have gone terribly wrong with Tether. And this was principally because, look, Tether couldn't tell people what was going on. People had basically no communication because Tether was it's kind of on the run right now. So now the nice thing about this, though, I mean, one of the benefits to fiat collateralized is that it's 100% price stable, no matter what happens in crypto land. Okay, Ethereum can crash, MakerDAO can explode, all this stuff can go wrong, and Tether will still trade at $1. Right? That's pretty cool. That's groovy. That said, that's true for crypto land, not true for real world land. Right? In real world land, if bad stuff happens to Tether or the issuer, then okay, maybe this is no longer price stable at all. And of course, another downside of this, there's a high regulatory burden and the risk of government shutdown. It means that the issuer needs to expend a lot of energy and money in maintaining compliance. That's kind of a pain in the ass, and it makes us expensive to run. And ultimately, Tether needs to pay their bills, and so does TrueUSD and all these other fiat collateralized stablecoins. Now, the nice thing about it, it's fairly collateral efficient. It's okay. It's basically 1-to-1. So $1 in collateral means $1 of stablecoin, right? This one might be well, what do you mean? Why is that interesting? So different schemes have different collateral intensiveness. Basically meaning, let's say that there's a lot of trading that wants to happen in crypto. And so there's $2 billion of demand organically for people who want to trade crypto. And so if people had enough stablecoins, they would trade using those stablecoins. But some schemes require way more collateral or way less collateral in order to satisfy that demand of the $2 billion that wants to get traded. So for Tether, how much collateral do you need to lock up in order to have $2 billion of trading value? Well, you need exactly $2 billion, right? That's reasonable. It's not bad. So Ivan will now take over and discuss the latter two forms of collateralization. Whoops. There you go.
All right, cool. So we discussed the fiat collateralized stablecoins, and they have a bunch of nice properties in that it's clear that there's enough money in the bank to support the price, and it's clear that the peg breaking is independent of anything that happens in the crypto land. But now there was the right question in the audience of what happens if the government comes in and decides they don't like this anymore. Do we have a reason to believe that this would be any more resilient than the previously failed attempts? So as far as the sketchier coins, does Tether have a higher chance of surviving than, let's say, Liberty Reserve? Well, the answer is no. Or sort of, is Gemini Dollar any better than PayPal? Not really. Both of them are legitimate. And the blockchain is kind of a method of keeping the records, but it's not really adding anything in terms of the power balance between the users and the governments. And then the whole idea of crypto is that it's easier to encrypt than to decrypt. So the surprising outcome is citizens have sort of more of a leverage in negotiating with the governments as far as owning their money. So with that in mind, can we create a crypto-native stablecoin where the price peg would be somehow independent of the assets in the bank that are as easy for the government to seize as, I don't know, Liberty Reserve coins? So this is going to be a little more technical. So wanted to get a read of the room. How many of you have heard of MakerDAO? Oh, a lot. And how many would say that they have a rough idea of how that works in terms of like where the collateral comes from, sort of why is the price stable, and sort of within which bounds? All right, fantastic. Yeah, so the idea, again, dollars in the bank account can be seized by the government, so Liberty Reserve failed. Tether probably doesn't have any higher chances. Let's use native crypto as collateral. But the price is unstable, so we can't just take, I don't know, 1 Bitcoin, which is 6 grand, and then issue 6,000 stable coins. That would not work. That would tie us to the price of crypto, which is back where we started. Now, what can we do to fix that? Let's over-collateralize. So, for example, if we take 5 Ether right now, and Ethereum is at roughly 200, so that would be $1,000 right now, and then we only issue 500 stable coins. And who here is familiar with ERC20 and what that means? Okay, so ERC20 is a way to issue your own token on the Ethereum platform. So it's kind of like issue your new magic internet money. All right, so let's say we over-collateralize, we have more Ethereum than our obligations to the stablecoin users. Now what that means is as long as Ethereum stays above 100, we have more Ethereum locked than stablecoins. So if, for example, again, if Ethereum goes down to 100, then we're at parity, and then if it's below 100, then the peg breaks, and that's similar to all the other situations we discussed where the peg broke, be it Mexican peso or British pound or whatever. But as long as the price is high enough, the system is working. The nice part is the breakage condition is easy to analyze. There's a specific price at which the system breaks. And another good property of this design is that the peg breaking doesn't mean that everybody loses their money. With Tether, if the bank becomes insolvent, or if the government takes away the money in the bank, then essentially everybody is left with nothing. In the crypto-collateralized case, what happens is as soon as there's price parity between the collateral and the stable coins, you do a margin call. And a margin call is essentially where you force a liquidation and a conversion. So whomever had, let's say, those 500 stable coins, they would get all of the five Ethereum that was in collateral, which would be worth 500 at the time of the conversion. So it's you didn't get cheated out of your money. You just got converted from 500 stable US dollars into 500 of Ethereum at that time, and now you're riding the Ethereum roller coaster with everybody else. The first attempt at that was BitShares, which was invented by Dan Larimer in 2014. Now he's building EOS, and within BitShares, they came up with their own assets instead of using a larger, more well-known cryptocurrency, which contributed to the system failing.
So in the event that the price falls,
Mm-hmm.
who lost the money? Like the issuer, or?
So actually, nobody loses the money if the price goes down to 100. The person who had 500 stable coins, they get 5 ethers, which is worth $500. So you don't lose money, you just get a stable asset converted into an unstable one. And then
The investor in the stable.
Yeah, the holder of the stable coin doesn't lose money. It's the
issuer, right?
yeah, whoever puts collateral in, they
Mhm.
lost money.
Yeah. but like whomever put the collateral, they lost money on the price going down, and then they sort of lost the rest of it. And then if, let's say, Ethereum keeps dropping and then it drops to $50, then the owner of a stablecoin loses half of their collateral as well, because now they're sort of exposed to the Ethereum price.
Yeah, do you know if MakerDAO or any issuer in general for this is doing something with the value that they have over the stablecoin pre any peg breaking?
Could you clarify as far as the?
You could like rent out the rest of the money for interest or trade it in some way. So if there's additional value that you have from your collateral over what is backing your stablecoin, you could do other stuff with it. I'm wondering if like MakerDAO does that.
That could work, but it has its own problems. So right now in MakerDAO, people who put their collateral are actually paying interest for the leverage they get. More generally, if you lend out the collateral in a way that could end up in the collateral being lost, then you make the system less stable, right? So if you have, in this specific example, let's say we have 5 ethers, and then not only did you issue stablecoins against that, but you also lent those for somebody to, I don't know, like trade CryptoKitties. Well, if they lost money trading CryptoKitties, now your system is becoming less stable. So there's very few use cases where you can lend Ethereum in a way that you can be completely certain that the money will be returned to you. And those are the only ways in which you can lend this. Otherwise, you're sort of combining the price risk with the lender risk. And ideally, for a decentralized system, you would not want that. So yeah, we discussed MakerDAO, which is currently the best known example of those. And Andreessen Horowitz recently invested, I think 15 million was even the previous deal, and then they recently bought up another large chunk of the supply. And then if you look at this price chart, this is the total circulation of the stablecoin. So if you look closely, the market cap grows steadily, and then there are sudden large drops. Anybody can explain why that could be the case? Any guesses?
They're setting aside for investors.
What's that?
They're setting aside for.
Not exactly. Yep. Precisely, yes. So anybody can issue the stablecoins. You just need to lock some more Ethereum into the collateral, and then the system lets you print more stablecoins due to that lockage. But then if somebody locked a bunch of Ethereum and the price keeps falling and falling and falling, eventually you need to liquidate that position. So these drops essentially mean that whomever was the least collateralized, whoever put the least Ethereum for the most stable coins, eventually the system deemed that specific position too unstable and then had to convert that. So what you get as a result is there's less stablecoin and less Ethereum in collateral, but the safety ratio goes up. Go ahead.
So do you know how they solve the fungibility problem? Basically, if you have 2 smart contracts with different levels of collateralization, the 2 DAI coins that they issue are not equivalent. So how do they kind of pull that?
That's a very good question, and we'll talk about that in. Oh, yeah. So like this is essentially the place to talk about it. So there's several designs you can do for the crypto-collateralized stablecoins, and I would want to see more of those being explored. But for now, the way MakerDAO does it is they have all of the debt positions backing all the stablecoins. So, for example, some of those, essentially, once you issued your stablecoin, it is no longer tied to a specific position that issued it. So let's say somebody put $1,000 worth of Ethereum, which is 5 Ethereum, issued 500 stablecoins. Somebody else put twice as much Ethereum, so 10 Ethereum, $2,000. And for some reason, they decided to issue just $100 worth of stablecoin. So it's crazy over collateralization. They have like 2x leverage. One of them is somewhat unsafe. The other one is way safer. But once those 2 chunks of stablecoin are issued, those become equivalent. So you can trade one of them in and out, and both Ethereum positions back the whole total supply of the stablecoin. And that doesn't have to be that way. Some people are considering other options where.
Yeah, if that's the case, then why are there specific liquidations that are only reducing a small amount of DAI? Like, why isn't it that there's a liquidation for all of DAI or none of DAI?
Right. So all of the debt positions are backing all of the stablecoin, but that doesn't mean all of the debt positions that are the same. So in the case where you have, let's say, 5 debt positions, one of them is very, very safe. So you have like 20 times more Ethereum than the DAIs issued. Oh, I understand the question. So when you issue new stablecoins, they are all fungible, so they are all traded together, but you still remember how many stablecoins you issued. So if you put a certain amount of Ethereum on the blockchain and then you issue a certain smaller amount of the stablecoin, you still that debt position still keeps the record of how much stablecoin was issued against it. So as a result, your debt. Actually, let me whiteboard. So let's say you have. We'll continue with like the examples from the slide. So we have 5 ETH here. So that's $1,000. And we issued 500. I'll use the word DAI because DAI is the name for the MakerDAO stablecoin. It could be, it's kind of the, it could be called the dollar coin, but for whatever reason they're calling it DAI, so let's stick with that. Or let me even draw it somewhat differently. So we have 5 Ether here, and then we remember that this issued 500 DAI. And let's say we have another position, which is 10 ETH. That's $2,000. And then we have $200 DAI issued by this guy. So this guy issued 500, this guy issued 200. Now the way the system works is you have 700 DAI total. And so you have one piece of collateral backing the stablecoin, another piece of collateral backing the stablecoin. Those got issued by the creators, and now they're trading freely on the open market. So anybody can buy and sell those stablecoins from the issuer. Now, let's say Ethereum price is going down. Now what starts happening is what used to be $1,000 ends up being 900, and then ends up being 800, and so on and so forth, until the system deems that the collateral here is a little too close. And then here the same thing happens, so it goes down, and goes down a little more, then goes down a little more, but there's still a ton of safety. So what the system does is when it looks at this position, it decides, okay, this one is too unsafe. Let me liquidate this chunk. And so 500 DAI get taken out of the system and receive Ether, but the rest of it stays. So this position is safe. And as a result, if Ethereum price in this example is going down, you would have this one liquidated first, this one liquidated second. So the chart, like the supply chart would be, okay, like you, if there was a drop, this would be a 500 drop because you sort of you liquidated the riskiest position, not all of them. Yep.
So it's specific coins that get liquidated, not pro rata amounts.
Correct.
So it's not really aggregated. Still, you don't get fungibility that way.
I think that what they do is they run an auction where an auction and a reverse auction where people essentially people give their DAI to be liquidated. So they sort of volunteer their DAI to be liquidated.
But essentially, specific collateral call and ultimately a liquidation call on specific coins. So let's say if I kind of sold the coffee and got those coins, I run the risk with some coins greater than with others of ending up with some indeterminate amount of Ether. Is that correct?
So not exactly. Since people are bidding on their liquidations, I guess there is technically the risk that nobody ever would want to liquidate their DAI, and then you would have the situation that you described where everybody gets converted. But that situation aside, as long as there are market makers who are willing to take a profit, the system is safe. So when you do a liquidation here, you don't necessarily convert into $500 worth of Ether. You convert into 510. So the guy who or the person who issued this position gets a penalty for kind of being the least safe participant in the system, and whomever decided to burn their DAI gets more money than they're entitled to.
What if we go to 400? The situation changes.
If the collateral goes to 100, well, the reason, again, that's a good question. The reason that does not happen in the MakerDAO system is that so they have a safety ratio, which is, I believe 150% is the minimum. So what happens is, as soon as the value is $750, everybody is entitled to do a margin call. So nobody would wait until it falls to 400. People would rather come in early and make a profit by sort of force converting that person into money. Yep.
What's the role of MCAR token in a CDP liquidation?
What's that?
What's the role of MCAR token, basically governance DAO token, in CDP liquidation?
Which
Liquidation.
right.
You do not just like ask people to get like DAI somewhat. Like you use an additional token MCAR.
Oh, that I'm not sure. I don't think that ever happened yet. But yeah, so for the rest of the audience, Maker also has the MKR token, which is kind of like the governance in the system, ownership, whatever token. And what that is used for is on the upside, when people are issuing new DAI, MKR accrues fees. So sort of some chunk of the fees and the interest rate goes to MKR holders. But if there's not enough money in the whole system to do a liquidation, then MKR token becomes kind of the lender of last resort, and those guys lose money on the conversion. Yep.
So with the design that you described, does this put some kind of cap on the size of a MakerDAO algorithm relative to Ethereum?
Precisely.
The thing that you're describing, the price impact would actually be that even though the market cap falls, the price of the DAI should actually probably increase in some sense, right? Because we have a shift of capital from Ethereum kind of like buying up the DAI, and then you should expect like a jump down in the Ethereum price if it was large enough.
So I think there's a couple questions here. The easier one is there a limit on the DAI market cap? The answer is yes, of course. You cannot have more DAI than, let's say, half of all Ethereum market cap because you need to be over-collateralized. So that part I agree with. And then as far as the DAI price going up, how would that work?
I'm just like, I'm from a more finance background, so I'm trying to think of like the microstructure, what happens when the price is starting to fall. So I'm just trying to figure out like if people are rushing to convert or something, like, you know, should I like understand that as like a negative demand shock for the Ethereum and positive for the DAI as they try to pull it out of circulation?
That's that's.
Buying up a currency and trying to buy the peg?
Well, that's somewhat complex to analyze because as Ethereum is going down, I would agree that initially you would, on the one hand, that means that people want to get out of Ethereum and into dollars. And then kind of by definition means that, okay, people want DAI as one of the possible ways to represent the dollar. But that also means that DAI now starts becoming more and more risky. Right? If you had sort of the total of collateral against the total of issuance, if the total of collateral is going down, then your stability guarantees are sort of worse and worse. Cool.
Is it possible to use multiple different assets to back DAI, like for example, Bitcoin?
That's a very interesting question. There's kind of there's two parts to the answer. One is organizational, and another one is technical. Organizationally, the question is which assets do you want to use? I think a MakerDAO, as it is moving towards the multi-collateral DAI, and specifically they wanted to start backing by real-world assets. So instead of just using Ethereum, they want to use, for example, even the Gemini dollar, which is pretty stable, or the Digix, the sort of the gold coin. I believe Digix is the first in line after Ethereum to be added. And that one I'm not as excited about because that kind of makes the system, then that sort of puts us back to fiat land where the system is exposed to government decisions, where if you have this like supposedly decentralized system, but half the collateral is in the bank account, then government seizing it would essentially lead to the whole system collapsing. And so that is as far as backing by real world assets. And then the other question is, can you back those by other cryptocurrencies, and specifically crypto native assets that cannot be seized by the government? That's a lot more interesting. And that's a good idea. The problem here is that all of the native cryptocurrencies are strongly correlated. So if you back by Bitcoin, Ethereum, I don't know, Zcash, you barely get any better than just backing by Ethereum. And sort of that's the nature of the dilemma there. And then finally, Bitcoin would probably be the only asset that's better than Ethereum to collateralize the stablecoin with. But it's actually technically pretty complex. That requires interoperability, where you need to sort of be able to lock Bitcoins trustlessly in a smart contract and then issue stablecoins against that. We'll actually talk about that in a little bit as far as specifically why that matters. So let me get to the next slide, and then I'll kind of.
So maybe a competitor from Microsoft can do a equivalent version of that on the Lightning Network.
Yeah, so the important part in the, I'm not sure if that part was clear, but the important part in the crypto-collateralized is that we don't just hold Ethereum in the bank account or in some person's wallet, I don't know, like the MakerDAO's CEO wallet. The important part is it's all held in a smart contract that's mediated by the system. So these ethers cannot be taken away by any government or any single actor. Their behavior is predictable through the smart contract. And then Bitcoin doesn't have smart contracts, so locking it is a lot harder. The problem with Lightning is you can transfer Bitcoins back and forth between people, but you don't have full interoperability. So you can't issue a Bitcoin token on the Ethereum network and essentially transfer those back and forth. So long story short, there's a bit more complexity to backing stablecoins by Bitcoin, but it's doable if the Bitcoin community is willing to somewhat amend the consensus. Yep.
So as I listen to this, right, nothing new or interesting here except you've sort of, put some electrons around stuff, sort of electrified it. I mean, if you take a use case and say, if we had the credit problem we had in 2008 in the U.S. market, right, Lehman Brothers letters of credits and bonds became worthless, right? They dropped 70–80% very quickly. And they were backed by buildings or some other assets, and those dropped, or mortgages or whatever it is, right? And what you saw was that as stable as people thought their collateral was, it wasn't stable. And the only people that were able to fix that was the Fed, right? No one else could fix, and Lehman went out of business, right? And in today's world, you've got a lot of assets, right? You've got bankers' notes where banks are borrowing every night from other banks that have excess reserves and so forth. And but those transactions are again, they function independently, but if they go awry, there is a power that steps in and stabilizes the market. And the word has stable coin in it, but I'm just saying, okay, let's take a use case and say the markets are doing what they did in 2008. Would this system actually survive?
So this was fairly long, so let me try and sort of tackle different pieces one by one. As far as what's novel and interesting here, that is not the idea to back your stablecoins by crypto. So the novelty piece is not that there used to be debt obligations backed by buildings, and now all of a sudden we have debt obligations backed by Ethereum, which somehow is any better. It's not. The novel piece is the fact that we have smart contracts, and the debt contract itself is locked into the consensus system. So we're kind of using we're using a bunch of cryptography to make it harder to breach contract here. In case of buildings and data allegations, and other than the risk of buildings becoming worthless, there was also the risk that whomever owns buildings refuses to honor the data allegations. With crypto, if you can use smart contracts, at least the risk of converting Ether into DAI or like into dollars, whatever, that risk is no longer present. So that's the interesting piece. And as far as the stability, I agree that obviously it's not a perfect guarantee, and the nice part is that the bonds are very easy to analyze. You know that, okay, like we issued the thing at Ethereum at 200, at 100, the system collapses. But we're not, sort of the design here is not promising stability, so it's more of a stable-ish coin.
Another like failure point could be like the price discovery. In the extreme case, right, you may not be able to send the price signal to the USD to DAI, so the DAI doesn't know.
Yeah, good point. Yeah, I agree. That's sort of right now. That's the one point of centralization in the system, and I agree that it's a risk. There's a bunch of proposals to try and tackle it, but I agree that at least for now that there is a risk and sort of a centralization concern.
But you had smart contracts in 2008, right? AIG basically guaranteed the CDOs, right? And those CDOs could, that smart contract fell apart. And the only reason those CDOs were actually somewhat whole is that the Fed stepped in and said, we'll guarantee for AIG and provide liquidity. And my big question is, pick the use case. All this is fantastic, right? And I'm being, for a technology person, I'm being a little bit questioning in terms of, would a system like this, even with smart contracts, because smart contracts still means you have the ability to honor that contract, and that means how deep is your pocket.
So I'll push back on AEG being a smart contract. I believe that is a regular legal contract that is enforced through courts. Smart contracts are enforced through full node participation, which some people claim is more decentralized or somewhat harder to break single-handedly.
Let me take a shot at answering this. So I think to some degree you're right. If a crash happened fast enough, right? If you just have like a negative infinity slope, where all of a sudden Ethereum goes to zero, clearly DAI isn't going to save your ass, right? Like all the assets are going to zero, and there's no coming back from that.
That's my point.
Yeah, and that's correct. That's correct. But that slope has to be really fucking steep, right? And I think some of the promise of DAI relative to systems that are mediated in meat space is that all this stuff happens really, really fast, right? So you don't need to call lawyers on the phone. You don't need to have human organizations coordinating with each other. Like all of these auctions happen automatically in the blockchain. And this is really good because it's mediated entirely by game theory, right? Basically, look, we are doing a fire sale, right? If you assume that people still want to make money, then you're going to be able to sell the DAI and collateralize the remaining system such that it's sufficiently safe. Now, no promises how quickly that drawdown happens if you have a massive cut.
If you have a 10 or 15% drop.
Exactly, but we've seen over this year, we've seen Ethereum drop by 75%, right? Massive drawdown. And DAI has remained stable, right? Because the system has worked. Now, that, in the early stages where the system is relatively small, so you saw in the previous slide, the issuance of DAI is, it capped out at about 50 million or something like that. So it's not a massive system relative to Tether. Tether's in the billions, right? And some of the, many of the early adopters of DAI might be kind of irrationally exuberant about it and be willing to recollateralize their positions to keep the issuance of DAI up. I think all of that is totally correct as criticism of the system. But ultimately, even in this year, when Ethereum just got beaten to hell, it didn't happen so fast that the system could not deal with it. So the primary threat would be, let's say, for example, every exchange got simultaneously shut down one day, right? That would probably be such a catastrophic event for the price of Ether that maybe DAI would not be able to withstand that, and there would have to be some kind of global settlement.
But it doesn't have to happen very often, once every 20 or 25 years, right?
Yes.
It's the black swan issue.
Absolutely. Yeah, and in that case, DAI would break.
Yeah, and I'm looking at this and saying, okay, another practical application is hedging, right? I'm an auto manufacturer, and I have to buy platinum someplace else, but I want to hedge that because I know how many cars I'm going to build this year, and but then I've got to pay salaries someplace else. So I've got currency hedge, plus I've got commodity hedge, and I've got labor hedge, and all of that, right? And that's a huge problem right now in terms of an application. And the smart contracts will help you with that, do some of that, but I'm not sure a human being can actually understand, what their positions are and how they're doing this, right?
Yeah, I'd say if there's one principal weakness of, there are several for MakerDAO, but one of them is definitely complexity. Like obviously we thus far spent the most time talking about this one because it's really complicated.
Although we didn't tackle the growth based yet.
That's true.
So the concerns this gentleman is raising right now, these are concerns I've been thinking about for a while, the exact same scenario with stablecoins. And one question I have for you guys is, do you think there's the possibility that the answer for a quote-unquote stable-ish coin or stable coins for possible to have is it's just too early in crypto? And the answer is whichever crypto ends up having the strongest network, whichever ends up winning over time, maybe that takes a decade, maybe it takes 2 decades, that's when you actually have price stability. In the meantime, any effort to force stability is going to be exposed to some black swan risk and potentially lose trust, make people lose trust in the system.
If it's okay with you, let me punt on that until after the presentation, because I think that's sort of more of a general question about stablecoins and crypto. So let's just try to move on, just so that we don't end up having people for longer than an hour for this portion of the talk.
So back to crypto-collateralized, we have it can fail, but we can pretty easily analyze the conditions and why that would fail and when that would or wouldn't happen. Then the benefit is that it's very transparent. All the collateral you have in the system, that's on chain. Everybody can verify that if you have, in this example, 15 ethers, then that's 15 ether on the blockchain. Everybody can see that it's there. It hasn't been lended out to support some other layer of complexity on top of the stablecoin. So that's nice. And then the problem with this design is, and there's been a few questions from the audience as far as like what's the total market cap limit and like what's the capital efficiency. Well, the obvious problem here is the more stability you want, the less capital efficient it is. So if you want stability to Ethereum crashing 5x, then you need 5x as much Ethereum as dollars and so forth. Is it a quick one or?
I believe so. I believe a lot of people will have a question. Was the incentive to put Ether in the collateral? But regardless of that, what's the correlation between creation of a DAI and the demand for a DAI? Looks like you have a sort of incentive to put your Ether into CDP and create some DAI. And this demand for creating CDP are not necessarily correlated with demand for stablecoin DAI.
That is an excellent question, and that's precisely the problem a MakerDAO is trying to tackle right now. I'll just give a brief answer to continue, and then we'll maybe expand at the end. Oh yeah, so the question was the demand for lending Ether is not necessarily tied to the demand of using the stablecoin. So what if a ton of people want to use the stablecoin? There's like $1 billion worth of demand for a stablecoin, same as Tether, but nobody cares to lend their Ether. What do you do then? And conversely, what if everybody wants to lend their Ether and earn a little bit of interest rate, but nobody needs the stablecoin? Both are good questions, and essentially you just need to look at where the market is and pay the interest rate accordingly. Personally, I would think that a lot of people need a stablecoin, so you would have to pay Ether lenders for issuance of the stablecoin. Turns out the MakerDAO team looked into that and have reached the opposite result. Turns out there's not as much demand for DAI, and there is a lot of demand for leverage. So a lot of people want to lend their Ether, issue stablecoins, sell stablecoins for Ether, lend some more, and essentially over-leverage their position into Ether. And as a result of that, what you have to do is you have to pay the stablecoin users from the lenders, not vice versa. But either way, those interest rates need to be adjusted to sort of work with the market. All right, so let's get over the final category of the stablecoins, which is growth-collateralized. This is probably the most complex to tackle, and there's plenty of different designs. So just as a quick read, anybody here has heard of Basis or Base Coin, Treasury Coin? All right, good amount of people. So the idea here is that instead of using Ethereum, we actually use instead of using crypto as collateral, we use the future promise for the utility of the system as collateral. So we expect that stablecoin usage increases over time, and more people need stablecoins. So let's say right now, crypto is a small chunk of society. People don't need as much of it. Let's say a year from now, people want double as much stablecoin as they want now. And then 2 years from now, they want triple as much stablecoins as they want now. And empirically, that's a reasonable prediction. Tether has been growing in market cap pretty much exponentially, so it seems like people do want stablecoins. Now, what that means in practice is we separate the people, the risk takers, so those who have an appetite to take risks and make money, from the stability consumers, and those are the people who use the stablecoin. The risk takers would be underwriting the issuance. So essentially, whenever you issue more stablecoins, they accrue in value to the risk takers, and they reap the profits. On the other hand, if there's a short-term price crash, it's the risk takers that lose money. That model was originally called senior shares and was invented by Robert Sams in 2014. So yeah, this is a little non-trivial to wrap your head around. Let me go over a couple steps of how the system works and sort of describe the decision tree for the system. First off, again, we have two assets. The risk taker asset, which we would call shares, because it's kind of like share ownership in the system, versus the stablecoin, which should be at $1. Now, since the goal of the system is to keep the stablecoin at $1, you can only have two problems. It's priced above $1 and it's priced below $1. There's no other problems for you to handle. Now, if it's above $1, that's an easy problem to have. You just print more stablecoins. So if your thing trades at I don't know, $1.10, just print as much of it as you need and sell it until the price goes back down to $1. That's pretty simple. And then the question is, okay, but who gets to print those? Who gets to profit off of selling those? Well, the shareholders do. So the risk takers who are underwriting the system are printing new coins, distributed pro rata, and then sell those on the open market. Now that's easy, but the relative problem is harder. What if the price is too low? What if your stablecoin trades at 90 cents? So there's more supply of the stablecoin than there is demand for it. How do you solve that? Well, clearly you need to reduce the circulation. You need to have less stablecoin in total supply. Well, the only way to do this is to somehow take those off the market and somehow burn those. And the way you do this is you essentially run an auction, somewhat similar to MakerDAO, except now you burn the coin in return for future shares. So, for example, if right now the price is 90 cents, what you're saying is, okay, who wants to be added to the pool of risk takers? Now you have some stable coins. Do you want to instead be converted into a risk taker, have new shares issued to you, and then in return for that, if the system goes back up, you'd be the one to profit. And obviously, the person selling their tokens doesn't have to be the risk taker themselves. They can just sell those obligations back and forth in the open market. But that's the general idea.
So that's basically a derivative.
Yeah, precisely. Yeah. And so we've discussed the stability bands in terms of the stablecoin being a random walk. And at some point, the stablecoin hits a boundary condition and the price collapses. But if it doesn't, then works out. So in this case, let's assume that the demand for a stablecoin is a random walk. And if and only if the demand is growing, so then the bias for this random walk is positive. That means eventually you'll reach infinitely high demand, or like not infinitely high, but sort of the demand would be higher than any previous number. Let's say you had demand for $1 billion worth of stablecoin, then that fell to $500 million. If the expectation over time is positive, eventually you would hit 2 billion, 4 billion, 10 billion, whatever. So presumably it pays to be a shareholder, and that means if the demand takes a temporary hit, it's good for you at some price boundary to be converted into shares. All right, let's do the next one. And this is the idea behind Basis, a growth-based stablecoin started by a few guys out of Google New York, and they recently raised 133 million, which made fairly big news because they're all sort of 25-year-olds, and the company existed for less than a year. So clearly, a lot of people do want to see this experiment go on. And now there would be a reasonable question to ask of, okay, is this a financial pyramid? Does this sound too good to be true? Can this financial perpetual motion device ever work? Well, maybe it can, maybe it can't. Who knows? People like to use the word pyramid to impose a moral judgment and say that, okay, it's a bad thing, it's somebody's trying to screw somebody else. But in reality, we have a lot of sort of growth-collateralized system in our society. The best example would be Social Security. You get old, you get paid on the hope that the future generation works hard and sort of pays enough taxes to sort of pay you back. And then when you're younger, you are the one paying taxes and sort of kind of buying out the previous pyramid participants in the hopes that the next ones would buy out you. And yeah, if you look at the total M1 money supply, it grew steadily over time. So the assumption that over time the growth rate is positive and the demand is positive is a fairly reasonable one. So it sounds like it could work out. And then unlike the previous two designs, this one is a pretty awesome investment if you get to be early on in this sort of exponential growth. In fiat-backed stablecoins, you don't necessarily make anything except a tiny interest rate on the dollar pool. In crypto-collateralized, the interest rate may be higher, and then in this system, all of the future money supply accrues to the shareholders. So in the sort of shiny skies, best case example, the demand never goes down. People just need more and more and more and more and more of the stablecoin. And what that means is all of the stablecoins are originally printed by the initial shareholders. So if you're one of those initial shareholders who paid 133 million, and then Basis went up to $1 billion, all the $1 billion goes to you before it's sold to the other people. If it goes to 10 billion, all those 10 billion go to you before it gets sold on the open market to the other people. So that's obviously a pretty amazing investment. And sort of the justification for why it could work is that as the system grows, it becomes harder and harder to break the peg because there's more and more diverse participants in the system. And we'll have a slide on that a little further on. Yeah. So essentially, you have two tendencies that fight one another in this design. The more demand growth you have, the better it is for you. If your demand doubles every day, that's insanely good. You just print a ton of the stablecoins, everybody loves you. If it doubles every year, then you're pretty good. And that would be roughly the Bitcoin case where the demand for Bitcoin, I don't remember the exact numbers, but the price seems to be growing exponentially. So I don't know, maybe 10x per year or 5x per year averaged over the last decade. But then the problem is it's very volatile. So you could eventually hit a situation where even though people roughly know that everybody wants Bitcoin, if there's a sudden swing of lack of demand, this could destroy the system where nobody wants to save it, and it's better to restart. And then in the middle, there's S&P, which is, again, pretty volatile, but gives you, I don't know, 8 to 10% returns a year. And then finally, the real GDP of a country, or even of all the countries combined, that is the lowest volatility, but also lowest growth. If you end up in that situation, that's kind of another point on the trade-off spectrum, where if you grow very, very slowly, so there's not that many new base coins that need, or sort of stable coins that need to be issued, but also the demand is very stable, so there's no sudden crashes, nobody wants to sell out all of a sudden, that could also be a precondition for stability. All right. Okay, so this is the last slide, and after that we can tackle some more questions in depth and discuss the various existing stablecoins. This is basically a summary of everything we've discussed so far. So there are several properties of the stablecoins that we'd want to evaluate, and there are the most important to users. The first one is stability. So what are the risks of the peg breaking? For fiat-collateralized, it's pretty stable. As long as you have dollars in the bank and you're tying to dollars, well, it's pretty hard to go wrong unless the government decides to ban you. For crypto-collateralized, stability is a little worse, because if Ethereum crashes in price, then you're screwed. And then for growth-collateralized, stability is pretty terrible, in that nobody knows when it crashes or why, or sort of like when's the right time to support the system, when is the flip over to shorting it and sort of contributing to the system's demise. For censorship resistance, fiat-collateralized is not censorship resistant at all. It's the same thing as PayPal, except you kind of strap on the blockchain. For crypto-collateralized, it's censorship resistant because, again, the crypto is in a smart contract. For growth-collateralized, if you implement all these auctions and a new seniorage through a smart contract, it's comparable in decentralization to crypto-backed. And then as far as capital efficiency, so fiat-collateralized is good, 1-to-1. Crypto-collateralized is bad because it's 3-to-1, N-to-1, whatever. And then for growth-collateralized, it's the most capital efficient because you pretty much don't need anything to start, at least in theory. In practice, you probably want some initial capital pool, because if you start with very high volatility and zero capital committed, then sort of the probability of crashing is pretty high. And then finally, there are the incentives to build the stablecoin. So who would want that and why? And there was a question from the audience, I believe, a little earlier, as far as, okay, so who's building this, why, what's the deal? For fiat-collateralized, there's not really much of a point in doing this. There's no get-rich-quick scheme. You have dollars in the bank. You sort of give a different representation of it. So as a result, pretty much almost or at least the biggest players building this are exchanges themselves. Originally, it was Tether built by Bitfinex. Now, Circle is building USDC, and then Gemini is building Gemini Dollar. And then the benefit is mostly in the sort of wide ecosystem benefits that people use your exchange for issuance and redemption. Everybody sort of believes you to be the most trusted party that has the money in your bank account, so it kind of bolsters the exchange and all the other components of it. But it's a little harder to build that independently. For crypto-collateralized, you get interest rates. In MakerDAO right now, you have interest rate that's, in fact, for MakerDAO, you actually pay interest rate on your crypto, so you get a little bit of leverage. You get to sort of be a little more exposed to crypto upside if you would be otherwise. But again, that's kind of a linear value add. And then for growth collateralized, it's a multiplicative value add, where if you invest into a successful, I don't want to use the word pyramid scheme, but if you sort of invest into this like successful, I don't know, whatever, exponential growth machine, then it's obviously very, very lucrative to you. So everybody's trying to build that one, and kind of unsurprisingly so.
Cool. So we've been going longer than we expected. So I'm thinking let's maybe like take a short break, so you guys can just kind of stretch out a little bit. Our talk, we're basically going to have a more open kind of format, where essentially the two of us are just going to chat with each other, and we're also going to kind of mix it with a Q&A at the same time. So you guys are free to ask us questions. We'll kind of riff on it, or just kind of follow threads as we come up with them. So originally we were going to do like a fireside chat thing and then a Q&A, but we've kind of gone a lot longer than we expected to. So we're just going to kind of merge them into one big soup of just talking in front of you guys.
And there were a bunch of great questions from the audience that we punted on, so we'd go back to those as well.
Yes. So what were some of the questions that we missed? There were some that we intentionally skipped on. You had one.
Yeah. So my question is, like, I think all this is super fascinating. I see the need for people to have as stable store value as possible today. That said, if we buy that all of these schemes are could become extinct because of the black swan risk, does it make more sense to just say, hey, wait a second, cryptocurrency isn't ready for stability yet, and this could be a 10, 20-year process, and whatever currency ends up having the most secure network, be that Bitcoin or something else, when it's ready, it will become as stable as any reserve currency. And I totally understand, I appreciate innovation and trying new things. What scares me personally is if we, with good intentions, try and sell someone on, hey, this is your dollar, and then it crashes because of a black swan event, are we ever going to be able to onboard that generation into any cryptocurrency, Bitcoin, Monero, whatever ends up winning later on?
Right. So very, very good question. In short, I think my answer is yes, as to should we be doing this.
Yeah.
So there are a few reasons why, and I think it comes down to a few things. So the first thing is that it's clear that crypto is not stable today, and it probably won't be stable anytime soon, right? And so that basically means, look, for the next 5 years or however many years, do we want something that basically can stand in as a stable asset? And I think resoundingly the answer is yes. There's a lot that you can't do in crypto without having that first. And that might actually be one of the prerequisites to getting to that terminal state, right? If we imagine that some kind of programmable money becomes this kind of future world dominant currency, well, it better be able to do basic things like, be able to dominate loans in it, or be able to have, try it out, right? If you sort of, you have a chicken egg problem, where you want the asset to be stable. Well, it's only stable if it's sort of this world-used asset. Once it's stable, then we want to use it even more because people want to use it as smart contracts and to pay salaries, and that increases demand, which means that it wasn't stable in the first place, right? So, I mean, if you think about it, a lot of people, especially people who are very, very pro-Bitcoin, will often claim that, well, won't Bitcoin just be the stable coin, right? Why are we doing all this crazy financial engineering? This kind of reeks of Wall Street hubris, right? You can't engineer stability every time that's happened in the past. That's failed, which is absolutely correct, as we've previously analyzed. So isn't it true that this is just another instance of the same, and it's going to all end terribly, and we're all going to be very sad when we sort of have our Mt. Gox moment of stablecoins? And to be clear, I think this is definitely possible for every scheme that we outline has some failure case, right? Centralized collateralized stablecoin can get shut down. Crypto-collateralized stablecoin can have too steep of a price drop, and a growth-collateralized stablecoin can just have things go badly, right? You kind of just tip it over the wrong way, and it just sort of the whole thing collapses. So all of these things can fail, right? But at the same time, it would be fairly surprising if an asset like Bitcoin, which was not designed to be stable, was as stable as something that the only reason why it exists is to be stable, right? In the limit, if Bitcoin becomes this sort of massive worldwide reserve currency, right, or this, not reserve currency, but rather store of value, well, not all stores of value are that stable. Like if you look, it's kind of a pain in the ass to bring it up, but if you look at the price of gold over the last 100 years, actually it's not very stable. It's stable within short bounds, but there are times there are sort of price shocks or changes in demand and supply. It's one of the reasons why gold is countercyclical with most economies, is that when economies go down, gold goes up. Gold becomes more valuable. But in a limit, if you imagine this, Bitcoin becoming this world-scale commodity, commodities are not expected to be stable. Their job is not to be stable. Oil is a great commodity. It's not stable, right? Vast majority of commodities are not stable. Gold is pretty stable, but it is nowhere near as stable as the US dollar, or as stable as an asset that was just trying to be stable. So that's my long-winded answer. I don't know, Ivan, if you
Yeah, I want to build up on that a little bit. So you mentioned essentially a steady state 10 to 20 years from now, where what if the sort of the magical crypto land stabilized, then there's the one winner, and sort of let's start working on stability at that point in the future. Well, I don't think it works to sort of consider that steady state in a vacuum. The ultimate definition of stability is being unit of account, right? Sort of US dollar is the most used one. Like when you think of your latte, you think of it being worth $5. So the two outcomes are what people call hyper Bitcoinization, which is apparently like everything fails and like everybody transacts in Bitcoin, and like you just pay for your latte in Bitcoins, and that's your unit of account because that's the biggest thing. And at that point, it's a little too late to worry about stablecoins, because sort of if crypto native already won, and if the ultimate currency is crypto native, then you don't need any extra stability piled on top of it. Sort of this purely digital uncensorable asset is already sort of the fabric for society, like the ground layer fabric for society. And then before that, what if crypto is smaller than US dollar? Sort of what do you do there? And in that case, it's always going to be sort of the same situation as it is now, where, well, maybe it crashes from now, maybe it doesn't, but at least we can get some extra stability built on top of what we have now. And holding DAI isn't amazing. It's vulnerable to a black swan risk, but it seems to be strictly better than holding Ethereum. If you want A, censorship resistance, B, low volatility for that asset, DAI is roughly as censorship resistant as Ethereum, but strictly lower volatility, because at some point you get zero volatility. It's fully tied to US dollar. At some point you have the crash, you get converted into Ethereum, and then you have par value but higher volatility of Ethereum. So sort of worst case is you get Ethereum. So from that perspective, it adds a little bit of stability at the cost of capital efficiency, and then people get to sort of twiddle those parameters for themselves. If you want, you can build sort of DAI 2, where DAI is the collateral, and then you like extra collateralize, and now your ratio is not 2x but 4x, and if you want to you can have 10x leverage, sort of whatever you want. However much your demand for stability can be balanced against somebody else's demand for exposure.
Sorry, one just really quick follow-up on what you said with the gold piece. I'm actually not an expert here, so I'm actually asking, but when we did have a gold standard, how much volatility was there then? And if that's the case, is it possible that there's no such thing as just like a stable state world? There's always going to be, some bandwidth of volatility.
Yeah, so that's a tricky question, because when you think about stability over long enough time horizons, right? You have to ask the question: stable relative to what, right? Because ultimately, cryptocurrencies are kind of unique in that, well, sort of, for a lot of things, right? At bottom, value. When we talk about value, right? If you ask an economist, are cryptocurrencies valuable? They'll tell you no. But cryptocurrencies can be priced, right? There are some assets that have value because they generate other things that have some underlying value. So like corn is valuable to me because I can eat it and I'm willing to pay for the food that's generated, right? Is gold valuable? Well, no, but it can be priced. It has some value because of the economic utility and industrial utility, but for the most part, this distinction is very important, right? So the price of gold, when gold was the monetary unit, right? The reality is that most of the time when we think about, is this currency appreciating or depreciating, we're doing it relative to some basket of goods that we're trying to hold as being like, okay, this is the constant layer of value, right? Now again, if baskets of goods are easier to attain in different times and places, which naturally they are because the world is getting richer and it's easier to make corn when you have better agriculture, blah, 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 right? It's kind of hard to really do a constant like-for-like comparison from, before the Industrial Revolution to today, how much was gold worth, right? I don't really know, and I don't know that anybody has a good answer to how to ask that comparison. Over a 10-year, you can sort of keep doing 10-year comparisons, and that's sort of relatively fair enough. Also, I should add the caveat: I'm not an expert, and I don't have a really, empirical answer to your question of like exactly how much has gold been volatile. But if you look at a chart of gold volatility over the last 100 years, it doesn't look like a flat line.
Actually, during the 100 years when we had the gold standard, the overall CPI, like core inflation, is actually the lowest during the entire 100 years. The overall 100 years, the CPI changes only about like 10%. So, but I think it breaks mainly because of the economic growth. At that time, when we had the Industrial Revolution, we also had gold in California and Nevada. But now, after everything gone, and then there's no new supply to represent the new value created in the system.
Right. Yeah. So I'm not going to opine too much on that because I'm definitely getting outside of my realm of expertise. But when you're running a government or when you're a central bank, your incentives are very, very different. Right. Your goal is actually not to keep the currency stable. It's to maximally grow the economy and to and very often, a central bank's mandate is not entirely, I want to keep an asset stable. Now, if you're a very shitty government, then you have even worse incentives of like, I want to get rich, or I want to sort of be engage in a little bit of cronyism, and that's where you see in most of these currencies that hyperinflate, usually it's a result of some kind of really malformed incentives. But much of the time, the reality is, for some people, what they really, really want is stability. For most central banks, stability is nice, but there are a lot of other really important things, such as low unemployment, continued economic growth, increasing GDP, and this kind of means that one again should not expect a U.S. dollar or a British pound or whatever in the limit to have the same properties as stablecoins, right? If a stablecoin is engineered to do only one thing, and that only one thing is to retain its economic value, its design would be different than a sort of U.S. dollar type asset. Yes.
Yeah, I was just wondering, very informative talk. Thank you for sharing insights. As far as you've thought about other categories that could sort of ensure stable coins, so you could say hard assets of stakeholders that have an incentive of securing the system. I mean, also the role of government has been very important, obviously, historically, to drive stability. And given that there's been so few innovations within governance in crypto, maybe we haven't really seen the answer there yet. Something like IMF or something that holds a basket of different tokens. Maybe that could also, I don't know if you have any thoughts on alternative ways of creating stablecoins.
So on that one, that's an interesting question. I would say that that question is somewhat separate from cryptocurrencies because it's sort of the promise within crypto is replacing a central authority that mediates the game design. So sort of, or it could be an analogy. In a government, you have a police force. That police force prevents murders and theft and whatever. It's easy to do that when you have one. If you have one player that's much more powerful than the rest of them, it's easy to say like, okay, that player enforces whatever outcome we want. Sort of the Fed comes in and saves the day. The interesting question is, can you organize many weak participants to be stronger than any single centralized one? And sort of that is the reason within crypto people try and sort of do this through various consensus algorithms and those game design.
It could happen in the future when there's more coordination between different crypto networks, that there's going to be some governing bodies that will then create baskets of like stable tokens essentially, right? And then because of the legitimacy of that governing body, that will bring sort of the value, which is not really happening right now because crypto is like this illegitimate industry in some way. It's just focused on business, on profits. But as sort of it grows, like there will be more tension between existing governments and crypto. So yeah, just wondering.
Agreed. I guess that's the hybrid approach where kind of fiat represents large, powerful actors. Sort of if you want to have dollars in the bank, that you're kind of tapping into the power of U.S. government. If you want Ether reserves, you're kind of tapping into the tens of thousands of full nodes that people are running. Can you do some kind of mix between the two and have various powerful actors coordinating between each other? Probably, and that seems to be also part of the direction where crypto is moving, where sort of is Gemini dollar an actor on behalf of U.S. government or on behalf of the crypto anarchists? Probably kind of in between.
So I guess first of all, great chat. I guess my question more geared, I guess high level, like from the investing perspective, when you're kind of evaluating all these different tokens, whether stablecoin or not, there tends to be a trend over any industry towards consolidation. And I think, this gentleman mentioned kind of the tension, and you mentioned as well, when it becomes big enough that the government want to step in. And just thinking about like the risk of, right now crypto is pretty small, but when it becomes bigger and let's say governments say, you know what, I know China's very interested in crypto actually, and if they want to pretty much take over a network, I mean it's a pretty small pool of capital to just go in and from there on control everything. And if you had crypto sort of take over or win, then it would actually just become more obfuscated who is actually controlling everything that's going on. And I'm just wondering like how you think about that risk or some interesting things that tokens are doing.
So I think it's important when you talk about attack vectors for cryptocurrencies in general to be really mindful of the security model of different cryptocurrencies. cryptocurrencies, right? Because we sort of kind of generally and vaguely describe these things as being secure, sort of with a caveat that, well, proof of work is this and proof of stake is this and blah, blah, blah. But it's always worth remembering that, let's imagine China wanted to attack Bitcoin in the most kind of straightforward way, which would be to accrue a bunch of mining power, or let's say attack Ethereum while it's still a proof of work-based system, is accrue a bunch of mining power and then 51% attack the system, right? So it's important to remember what that means. When you 51% attack a system, what that means is that now you are able to double spend, okay? Which means, I send, 100,000 stablecoins to this exchange and say, hey, I want to sell these for some other asset. And then what I can later do is unspend those coins such that the exchange is, they're on the hook for having made this trade, even though they lost those 100,000 stablecoins on the blockchain, right? That's what China could do. That's what any actor that decides to take a bunch of hash rate and attack the system could do, right? That would be really shitty. But there are certain things that you cannot do no matter how much hash rate you get, right? Even if you have 99% of the hash rate in the system, you cannot spend anyone else's coins. You cannot, change smart contracts that are on the blockchain. You cannot, you can't actually go in and fuck with the stuff that makes the system work the way that it does. All you can change is the guarantees about the sort of forward progress of the blockchain not getting reverted, right? Now, to be clear, if China or whatever central authority decided, fuck blockchains, we don't like this, we're going to shut it down, chances are the last thing they would do is go and buy a bunch of hash rate and do this really complicated attack, right? That's not what they would do. They would just ban it, and then they would kill people, right? Or throw them in jail. Like, that is the easiest, that is the one thing governments know how to do. It's a lot cheaper than buying a bunch of hash rate, and it's not that hard, right? And there'd be plenty of support for it by just saying, look, these are criminals, these are bad people. So if in fact governments did decide they wanted to gang up on crypto, I don't think, there's this famous SCPD where it talks about this guy who's like, he's like encrypting his hard drive with all this, fancy encryption and saying, look, if somebody wanted to break this, this encryption scheme, they'd have to, spend tens of millions of dollars on all the, brute forcing to crack the thing. In reality, a criminal would just grab a $2 wrench and beat you with it until you told them the key, right? So governments are going to do the same thing. They're not going to try to break our crypto. They're going to beat us over the head with wrenches, right? So the only question is, can you decentralize the thing? And can you get it out there fast enough and effectively enough such that the wrench attack stops working, right? That's the whole promise of all of these systems, right? Nobody ever, I don't think it's really serious or credible to claim that Bitcoin is not censorable by a government. Of course it is, right? But no government would do that. It's just the dumbest way possible to try to solve that problem. And it's not the tool that governments traditionally use. 20 years from now, who knows? Maybe that changes. Maybe the dynamics around governments and crypto is so different from what it is today that the world looks very different. But today and anywhere in the near future, crypto is like a gnat in government's ear, right? It is not significant enough for them to engage in this kind of espionage-like thing, secretly buying a bunch of hash rate and performing 51% attacks. And the reality is it would be so expensive and so complicated, and almost undoubtedly news of this would leak, and people would fork away, and then you'd be like, well, fuck, we spent all this money. It's just a mess. And this is exactly the thing that cryptocurrency enthusiasts spend all their time thinking about. So it's the worst way to attack, right? It's like, it's just basic, art of war stuff, right? Like, people are fortifying this wall. That's not the wall they're going to come in from. That's not, the way that they're going to attack you is they're going to make everything illegal and make it really hard to do anything. And people will just, people give up on Bitcoin out of, annoyance, right? That's really the biggest risk to crypto. It's not that governments are going to start buying up a bunch of hash rate. It's that it's just going to be such a pain in the ass for you to find Bitcoin. You're going to have to go find some random guy on Craigslist to buy your Bitcoin from. They're like, yeah, you'll just be like, look, okay, I like the idea, but I don't know. It's not, I have better things to do with my time.
So Haseeb gave the bear case. So the light at the end of the tunnel is that cryptography generally makes it harder to attack than to defend. So sort of 2,000 years from now, if you have gold and you weigh 100 pounds and I weigh 150 pounds, I come and beat you up and take your gold. And now with cryptography, I need to be, I don't know, 1 million pounds to beat you up and take your gold. So it just makes the attacks more costly. And kind of same with communication. Previously, it was a little easier to snoop on plain text. There was a big war in the 80s as far as trying to classify cryptography as munitions, and that failed famously, where it was considered free speech. And from that point on, turns out people can communicate, and the discrete log problem is so hard that sort of I can encrypt something on my smartphone, and at least hopefully before the NSA revelations, people could think that like the government cannot decrypt it. And then 30 years later, it turns out you can also transfer value in that way. So I mean, obviously, I'm kind of more on the crypto nerd side, where it is more about sort of the fortifying the wall that the government does not intend to break. But even as far as all the sort of backdoors and side doors, you could still try and use cryptography in clever ways to make it a little harder for the government to block those. And Zcash would be a great example where, okay, the government may try to ban you from having crypto, but if it's a shielded address and you have it memorized or, I don't know, on your Trezor, then it's pretty hard to prove that that this is what you did wrong. And ultimately, the government sort of balances between, like the government sort of always pursues the most cost-efficient way to reduce harm. So if it's easier to punish thieves than it is to punish cryptocurrency holders, then sort of like between 1 unit of harm from thieves and 1 unit of harm from crypto holders, you just go and punish thieves because it's easier.
Not to belabor it, my point was actually more on the centralization piece than I guess the usual talk of like, what if they want to destroy it? It was actually, they join it, but then they're pretty much the whales. And they effectively remove all the benefits of having a decentralized protocol.
Yeah, it's kind of difficult to really follow the trend line to like, you know, if these systems become so big that they are, you know, in any way proportional to like the issuance of actual fiat US dollars, right? It's very hard to imagine what that world looks like, because, you know, most likely things get nowhere near that point before, if we have, you know, these kinds of stablecoins, either one, the US government or some other major government starts issuing their own competitors, sort of a digital US dollar, and basically make the other synthetic versions illegal and say, you know, this is the only one that we accept as legal tender and the only one that you're allowed to accept as if you're a merchant, et cetera, right? Fairly straightforward to do. Or alternatively, you know, one of these systems might just get co-opted. If in fact it's a fiat-collateralized system, the US government might eventually just say, hey, Gemini dollar, you guys are doing pretty well. We're just going to take this one over, and now the Fed will run Gemini dollar, right? So I don't know. It's really, you know, this is all in the realm of speculation in terms of what would happen if they get that successful. Either way, if they get that successful, everybody in this room looks super smart 10 years from now. So that's, I think, the important thing. Yeah.
So I have a question. This is about the use cases, right? So right now, all the stablecoin described here are really for like basically people to trade for like speculations. So I need to have a place to like record how much value it represents in a dollar type of thing. But do you think there is some other use cases at all? Like, for example, using cryptocurrency as a form of unit account and payment type of thing? And like, first, do you believe that scenario will happen? Or like another question is, if it happens, how long it will take for it to happen?
You want to take this?
Well, that's a good question. And the problem is, so far, the biggest use case for crypto is money. And money sort of doesn't do anything until it does everything. So sort of you don't really denominate half the goods in Bitcoin and half the goods in USD. You denominate everything in USD up until you sort of do a full switch. Seems that in the previously in history there were switches where people switched from one form of money to a significantly different form of money, from the gold standard to issued notes, and then even before that there was shells. So seems plausible that the switch would happen, but hard to say. I don't know. You wanna?
Yeah, I think in the short term of like talking about, you know, today, I mean, we have these tokens, so they exist, right? DAI, you can go buy some right now if you want to spin up MetaMask and go hunting, right? The reality is, right now, the organic demand for these tokens is fairly low outside of trading. There are a lot of reasons for this. I think we'd have another talk if we want to belabor all the reasons why there's not that much demand for them right now. But the reality is that in order to have demand for these things, either one, you need merchants who are entirely on the blockchain or want to take blockchain-based payments. Right now, you know, if you're a merchant and you know, you probably don't really. First of all, very few people know what DAI is. Very few people hold it. Tether is not even traded on Ethereum, so Tether has a very small issuance on Ethereum. The vast majority of it is on the Omni network, which is a Bitcoin sidechain. And then the other stablecoins we described, Basis hasn't even launched yet. Some of these are newer, they don't quite exist yet. Some of them have really small issuances on Ethereum. So the reality is, my guess would be that we'll get a better litmus test for the organic demand for these stablecoins once there's a sort of flippening within stablecoins where something takes over Tether, right? Right now, Tether, being the vast majority of the stablecoins in existence, has the most liquidity. So if you're going to hold any stablecoin, you probably want to hold Tether because that's what people will trade with you for, right? If you have a bunch of DAI, well, it's like you can't really trade DAI for Bitcoin, right? So it's kind of less useful for you if just as a coin to transact with in the world. If that flips and there's an Ethereum-based stablecoin, then I think it's quite likely that you'll start seeing more experimentation where one stablecoin just sort of races ahead, like you mentioned. When something's money, it becomes money everywhere, right? Very, very quickly, because money is the ultimate network effect. So when one app that starts getting used more frequently accepts payments in DAI, or whatever that Gemini dollar, whatever it is, most likely there will be many, many followers because there's just that's the one that everyone uses. That's the one that everybody has. And it's quite likely you'll start seeing more things like, prediction markets already. If you look at Augur, Augur has a huge boatload of problems. But one of them is that, betting on some kind of long-term bet in Ether, you're kind of making a twofold bet. You're making a bet, one, on the thing you're betting on, and second, that Ether will still be worth something by the time the bet's adjudicated, right? That's kind of crappy. There are a few other things like games and whatnot that people have some organic demand for. Gambling, which is forever and always going to be one of the killer apps of crypto. I think right now there's so many growing pains and so many scalability pains with Ethereum and with a lot of the dominant platforms that it makes it hard to really know what's a fair test of how much organic demand there would be if we had more scalability, right? So right now, I don't know that for the next year or two, until we start seeing really, really dominant, scalable smart contract platforms, what the answer is of do people want this for any reason other than for trading? I think the answer will be yes. I think it's hard to predict in advance which of those will be bigger use cases than others. But once you start having stablecoins, then it's kind of like, okay, well, we've got everything there to start doing, reasonable debt issuance, or start doing, paying someone's salary in crypto. We'll see. I think I don't know, but we'll see fairly soon. Yes.
So you guys have done a fantastic job, and especially making people think of things they haven't thought of. Everything that you brought today shows a huge amount of abstraction, right? You're abstracting a whole bunch of things, risk and fungibility and all of that. There's only really two things that have sort of on an abstraction level have lasted for any amount of time. One is religion, and the second is money. And the first one is sort of cracking today, where people are saying, what is religion, and that's been around for at least a couple of thousand, maybe 5,000 years. Money has only been around, in one sense, less than 50 to 75 years, in the sense that, for example, if you had D-marks back in the 30s, it became worthless. If you had pesos or whatever it is, right? And the dollar's only been, the actual money used to be British pounds because they had the biggest army in the Navy and control stuff. And now it's us as Americans, and the dollar is that. But that's also broken, right? And I still don't understand, from an abstraction level, how do we build something, which is a great concept and which says this is value and this is something you can count on. And I think at some point the dollar will weaken because our global power, we were at one point 35, 40% of the world GDP, and we're, I think, down to 18 or 20%, whatever it is. It's going to weaken, right? And so there's probably an opportunity in specific use cases to do this. And so what I would suggest as a second lecture, if you guys are willing to do that, is to actually take some use cases and walk through how it may work and not work, where it has advantages and disadvantages, right? Whether it's CDOs, whether it's T-bills, there's probably at least a half a dozen. In reality, there's a couple hundred financial instruments, but then seeing how does it work with this and where are the weaknesses, because that's how you're going to get adoption.
Yeah. I mean, it sounds like one of the kernels behind the statement you just made is how do you build something that really lasts? And I think you're right to call that out, because ultimately, this entire enterprise of building decentralized internet money has only really been an idea for about 10 years. Right? Bitcoin is not even 10 years old. So I don't think anybody in this conversation can credibly claim that we know we're building something that's going to last. I think it's quite plausible that 10, 15, 20 years from now, cryptocurrencies will be something that we just forget about as this crazy idea that we kind of thought could be a thing 10 years ago and couldn't, or perhaps something supersedes it that is better designed, maybe more thoughtful, more built to last than what cryptocurrencies are today. I don't know. I think ultimately, in one of the things about crypto that makes it, I think, very different from the normal financial system is that when you build a financial system, when you build a government or a new state, you have to build something that's going to last forever, because these systems have a way of just persisting, right? And once you put bureaucrats in place, they fight tooth and nail to keep the institutions that you originally erected alive, and you end up getting Supreme Court justices who say, "Oh, the founding fathers got it right." I will make sure that this sort of gets enshrined and never changes. Crypto is kind of unique in that it allows you to build systems that are pure experiments, and that if they don't work, can be taken down without causing anyone a loss of life, without stranding anyone, without creating migrants, without destroying an entire culture. This is pretty new. Normally, if you ask economists, like, "Hey, how do you run experiments?" They sort of slink and kind of say, "Well, we kind of can't really run experiments because, unfortunately, economics is an observational science." Whereas crypto allows you to sort of play with economics as an experiment. And I think this is new, and I think we, to some degree, it's important not to conflate the two. It's important to maintain the mindset that, we're trying things, and most of these things are not going to work. Absolutely not. Same thing with these cryptocurrencies themselves. Very clearly, the vast majority of them are crap. No one uses them, right? If you look in open coin market cap, the amount of these cryptocurrencies that actually have real user adoption is tiny. But this is normal. This is the same thing you see, this sort of, this Zipf's law distribution to companies that sell products, to startups that never make it past, the very early seed stage. I think this is okay for the stage we're in right now of crypto, of experimenting with how can we build a different fundament beneath a financial system. Some of these things will work, some of them won't. Some people will lose money, some people will make money. But in the meantime, we are all going to be beneficiaries of the learning of which of these systems actually work and which ones don't. And ultimately, the nice thing about it is that if you don't want to play, you don't have to, which is very different from launching your own state, where ultimately the people who live inside your economy are essentially coerced into being subject to your economic policy. And crypto is, again, unique in being this sort of opt-in economy.
And as far as building things to last, and I think as far as the talk on what could be the real-world use cases, I think the time for that talk would probably be a year or two from now, because right now there's genuine technical limitations as far as throughput that prevent people from building a lot of the things they want to build, which is actually, if you think about it, that's good news. If the only bottleneck was real world, which is, okay, we invented this crypto thing, but nobody wants to use it, nobody cares, there will be a problem. If it seems that some of the problems need to be solved on a technical level, that's a good thing. That means you can solve them and then sort of take another look a year or two from now. Yeah.
So assuming stablecoins do well, we have stablecoins in the world in the future, do you feel like it's going to make it harder to go from payments and speculation use cases into native cryptocurrency use cases like Fiat-coin and stuff like that, where they're using coins for their purpose or the protocol's purpose rather than making payments, because all of a sudden your stablecoin does payments way better than anything ever before, and speculation is just kind of like, why bother with speculating on cryptocurrency if it doesn't actually lead to anything? So are we actually like creating a larger barrier for us to get past this phase of cryptocurrency?
Are we creating a larger barrier?
Because stablecoins will work so well for payments.
And that will prevent what?
it'll prevent us from needing to use cryptocurrency for anything else.
That's an interesting way to put it. I wouldn't think of it that way. What I would think is that, many of the tokens that exist today are kind of not. They're useless, right? If they weren't there, we'd all be happier for it. They're sort of a lot of companies when they go raise money with a crypto project, they basically shove a token in there, and that token is kind of their way of not doing a pre-mine, right? They sort of say, not doing a pre-mine, but rather the token is a way of not collecting revenue directly, right, or not charging a fee directly. They're basically kind of moving the fee somewhere else into, hey, you have to use this shitty illiquid coin, and we have a bunch of it, and we're going to slowly sell it on the market, but it doesn't look like you're paying a fee, even though in reality you kind of slowly are, right? This mechanism is cute. It sort of, kind of took the world by storm last year. I think it's pretty clear that this is not what the future is going to look like, right? At least I don't think so. I could be wrong about that, but I could be. I don't think that's how it's going to play out. The reality is there are some coins that do make sense. And take Filecoin as an example. Filecoin is a system where the coin itself serves some very fundamental mechanisms within the Filecoin system that you could potentially use a stablecoin, right, to secure the Filecoin network, but it would actually change some of the properties of Filecoin, because, for example, if you wanted to buy up enough stablecoins to, if Filecoin is this proof of stake network, if you want to buy up more stablecoins that are currently staked on Filecoin, it's actually not that hard to do, right? You can just basically buy them all at market price. If, on the other hand, the supply of Filecoin is much more limited, and a bunch of people are staking it, then it's really hard for you to get 50% of all the Filecoin in existence and then go break the system, right? So there's some properties around scarcity, some properties around using something as the staking coin of some native system that give it different properties that a stablecoin would not totally satisfy. But most of the time, a stablecoin is sort of good enough. So I think that the distilled to its essence, the answer is basically yes. There will probably be less companies doing stuff once people actually consolidate around stablecoins, because there's fewer coins that people are going to say, oh, okay, that makes sense, right? When you have so much credulity in the market, there's a lot that people can get away with. Eventually, and right now we're getting there. ICO issuance has gone down and down over the last 6 months to getting closer and closer to zero. But I don't know that it'll ever be exactly zero. But I think now it's much more common that you issue a coin and nobody wants to buy it because they don't assume it'll automatically appreciate.
Yes, to look at it from another angle, people got to play investors for a little while, where they sort of conflated payment mechanisms and investing into the Filecoin as a system. Turns out that uninformed investors are mostly bad investors. So now we're back with a system that people who need money have money, and people who want to invest in companies sort of specialize in that. Yeah. Go ahead.
The woman back.
So I'm coming at it from a non-technical point of view. So do you think that marketing and community and business development are more important for stablecoin projects versus other projects in the crypto ecosystem, or equally important or less important as investors?
I would say it's not as much marketing as sort of plugging yourself into the right, how do you call them, places of power. So MakerDAO, for example, is a great design, but they haven't been able to get themselves listed on any large exchanges, and as a result, the total supply is much lower than you could have expected. So it's not so much marketing in terms of sort of convincing people that, hey, you want to use this. It's being the payment system, it's being available on large exchanges, and also tying yourself into a merchant. So some people like DAI, Augur likes DAI, hence a bunch of the Augur bets can be done in DAI. But if there's no goods available for the stablecoin, if it's not the center of concentration of liquidity, then nobody uses it. So it's a very different type of marketing that seems to be closer to, I don't know, B2B sales.
Yeah, and the other thing is market making. All of these coins need market makers in order to actually be very liquid on many different exchanges. So if you look at what stablecoins are doing actually in the marketplace, they're not trying to convince consumers that, like, hey, use us rather than the other one. What they rather do is just get order books to consolidate around their coin, right? And then once that happens, you'll just use their coin. You won't ask any questions, right? So the way to do that is relationships with exchanges, and then relationships with market makers. And if you can get those two going, then that's how you start, pumping life into your machinery.
Yeah, because on the marketing side, sort of, you don't necessarily need to convince somebody, hey, this dollar is better than the other dollar. It's roughly the same dollar if it's available for you.
Yeah, it's one of the curiosities of stablecoins that if you think about it, when they're all working well, you can't tell the difference, right? They're all trading at $1. So it's kind of when we talk about this stablecoin design has this problem and that one has this problem, clearly none of that is baked into the prices because they're all trading at exactly the same price, right? So there's kind of a weirdness to how stablecoins sort of operate in the marketplace. And the reality is the vast majority of holders of these coins don't give a shit about anything we just told you. They just see, okay, this is the one that I can use to buy my OMG or my Spank chain or whatever. And so that's what they buy and that's what they use to trade. Yes?
Yeah, question more about MetaStable. So Tether showed some really great trading opportunities recently. It's down like 90 cents for like a day, and then it went back up to $1-ish. Do you guys actually look at the mechanisms behind stablecoins and make bets as to what would be a good trade?
So we actually don't do short-term trading. So basically no. We're essentially like a long-only type fund. So even though we're structured as a hedge fund, we really do more venture-style investment. That said, we also don't have, although we think that we understand stablecoins pretty well, we don't really have like insider information that we know Tether's this or that, right? So like I don't think we were up what was it, Tuesday night, watching the Tether debacle. Yeah. We didn't know. I mean, we had no idea if like we were going to wake up the next day and it would be collapse, or if it was going to be at 80 cents, or if it was going to be at $1. We had no idea.
But do you even track, even if you're not going to trade, just track it to compare the number of trading opportunities for that versus USD?
Yeah. We try to keep sort of tabs in the market and get a sense of how stablecoin market share is changing over time. And we also know many of the people behind a lot of these projects, so we have a decent amount of insight into how the space is evolving.
Yeah, so we try to keep track, but our expertise is more on the technical side, sort of different consensus algorithms, scalability projects, this kind of stuff. We don't necessarily have any specific insight into, okay, is this Puerto Rican bank solvent or not? That is a pretty separate area of expertise.
Yeah, we're not traders. Yes?
So this is a little bit unrelated to stablecoin. Just now you mentioned since there's still scalability issues, some of the killer apps you think cannot be deployed yet. So any of those killer apps in your mind? Because right now, basically the things we're looking at on the the apps are mainly just betting or like FOMO 3D, those type of speculative or gambling games, right? The apps that's popular. Wall Street is the killer.
Well, first off, so what is different about cryptocurrencies? It is the fact that you can transfer value. So that kind of by definition constrains you in a bunch of ways where like if you don't need to transfer value, don't do it on crypto, right? If you want Twitter, just do it in a centralized way. So that's already a justification for why you start with the gambling use cases. So at the current Ethereum throughput, which is 10 transactions per second, it's only these high throughput financial contracts that could be used. So that would be stuff like MakerDAO, exchanges that let you trade in other positions, maybe financial derivatives like DYDX. Next up would probably be games, and again, these games need to have some form of value tied into them. So sort of if you have a little dragon or like a little asset that you can win or lose, that would be the next wave of use cases once you get to, I don't know, 100 to 1,000 transactions per second. And then from that point on, I would say it's fairly hard to predict. In the limit, if you manage to invent some kind of side chain that makes it almost costless to do decentralized transactions, you could see, I don't know, decentralized Facebook and Twitter working out just because if it's costless to do on the blockchain, you'd rather do it on the blockchain and own your data as opposed to hand over the control to some centralized third party. But I think that's super far out into the future, so I wouldn't want to speculate too much on that.
Yeah, I also wouldn't knock gambling too much. Gambling, people fucking love gambling. And they love it everywhere in the world, and they've loved it forever, and they'll continue to love it. So I would be I would not be surprised if the first like killer app of crypto. I mean, so I think the reality is we already have a killer app for crypto, and that killer app is trading. People fucking love trading crypto, right? Like if you think about it, like the experience that people have with crypto, the vast majority of people today who actually have touched crypto in any way, they never touched a private key. They didn't run a Bitcoin node and download some client and like check the SHAs to make sure it matched. They didn't do any of that. What they did is they logged in on Bitcoin or Binance or whatever. They went through all this laborious trouble to figure out what any of this stuff was and wiring money and then doing it so they could watch numbers go up and down and basically gamble on internet assets, right? That's basically a game that they were playing that was backed by crypto, right? And clearly now that this game they're not making money from it anymore, people are less excited, but there's still some people who are sort of in the game. I would imagine that the first like really massive killer app for crypto. I mean, trading was clearly huge and continues to be very, very, very big. I mean, at the peak, on the order of maybe 50 million people in the world who were trading crypto or speculating on crypto at the height. My guess is that trading crypto is still pretty hard to do. It's still pretty complicated. It doesn't really feel that game-like, right? But fundamentally, the dynamics behind it are basically just this variable reward ratio, random. Sometimes you make money, sometimes you don't. Without really any deep insight into what am I trading, what am I doing? I wouldn't be surprised if the first real killer app for crypto is some totally frivolous, really stupid looking game that is like a Farmville-like game that has some gambling component to it, and it just takes the world by storm. And now people who are not even sophisticated enough to open up Coinbase or Binance and figure out how to wire money to a thing, just figure out how to send money to some dumb farm game, and they can take carrots from their friend's farm or something, whatever, and all this somehow they make money along the way for being early into playing the game, and this taps into the fact that people love playing games and they love gambling, So if there is a killer app, like something that just sort of takes the world by storm in the way that we imagine killer apps like Facebook or whatever to do so, I suspect the first thing that does that will not be any of the awesome, kind of idealistic projects that we're describing. All the stuff of decentralized finance or prediction markets or whatever, I think these are much more likely to be sort of slow burn, take a while to get there. Really, you have to build a lot of infrastructure along the way. And the reality is, the vast majority of people are never going to use them because they don't need them. They don't provide the average person value. In the same way that Wall Street and all the derivatives that exist in the financial system are massive amounts of value that are being moved around every day. The normal person never has any idea any of that's going on because they have no use for it. But that doesn't mean that a lot of value is not being generated for the people who are using those assets. So,
and a good measure of what is the killer app is essentially how much new money came in. So how many people bought their first crypto to use that app. CryptoKitties, for them, if you look at sort of who was buying all of that, the vast majority of those were fresh deposits and fresh addresses. So sort of turns out gambling is enough to get somebody to buy Ethereum. Like, people didn't want to hold Ethereum by itself, but they were interested enough to go through all that hassle to buy their CryptoKitty.
Actually, the only problem I have with the game thing is game is typically, if a good game, typically is centralized. So in that case, do you really care about decentralization in that sense? Like,
that's a good question. I think it depends on the game. I think you're absolutely right. Not every game makes sense to be on a blockchain. In fact, the vast majority of games don't. And to design a game for the blockchain, like if you think about it, it's very different from normal game design, right? Normally in game design, let's say you're Blizzard, right? You create a game, you create World of Warcraft or whatever, okay? When you create your game, you balance it, you change it, you add new things, you take things away, right? In a blockchain-based system, that would not be okay, because it'd be like, hey, I paid a bunch of money for the sword. Now you inflated the supply of swords. What the fuck, Blizzard? You screwed me over, right? When you have this pure economic component to a system and you endorse it, that carries a bunch of constraints that game designers right now don't really have. So I think to design something for a blockchain as a game, I mean, CryptoKitties is like the perfect example of a blockchain game. It's kind of barely a game, but if you call it a blockchain game, it's basically almost like trading cards, right? You like trade new kitties, and that's like the issuance of a new trading card, and that trading card is worth something based on how old it is. And trading cards are a perfect example of a blockchain native game because you only ever issue more. You never take things away, you never balance things, right? It's like Magic the Gathering, right? In Magic the Gathering, there are only ever new cards. And over time, more and more cards get issued, right? And that just changes the game through this immutable game design. of adding new elements to a game but never taking anything away or balancing anything within that game. Trading cards are a perfect example of that. Most things don't work that way. It would be super hard to build most games only adding new things and never taking things away. So I imagine that whatever game that is will be pretty different and unique relative to games today. And game designers who work on this will have to put a lot of thought into how to design a game differently for that kind of design mindset relative to how games are designed today.
Invest?
Yeah.
Hi. So you mentioned that you guys are tracking projects and scalability and interoperability, and a general mention is usually dependencies on projects that are focused on that. I'm curious what kind of projects are you guys tracking right now and believe will be one of the few projects that will be working on scalability and interoperability?
My pick would probably be Coda. Any chance you've heard of them? Yeah, so for the rest of the audience, it's a project that uses zero-knowledge proofs to compress a bunch of transactions into kind of like a single proof. So instead of everybody going over all of blockchain transactions to be a participant, they essentially get to sort of have like a little seal of attestation that shows, okay, these are 1 million transactions. This is the outcome. You can verify that without redoing the full 1 million transactions. So that's a very interesting approach to scalability, which we invested in and we like a lot.
For interoperability, I'd say I think Cosmos is probably one of the most promising projects. You laughed. Do you work for Cosmos? No? Okay.
Yes, I do.
You do?
Yeah.
Seriously?
Yeah. I coordinated with you.
Oh shit! Okay, sorry, I didn't recognize you. You're wearing giant glasses and a hat. Okay, awesome. Yeah. Okay. Well, I would actually say Cosmos. You're very far away. You're in the back of the room, so I did not know that you were trying to goad me into saying that. I think Cosmos is awesome. Yeah. Well, I think Cosmos is awesome. Probably one of the most plausible interoperability plays in the space, and they have their own opinions on scalability. I don't know. I think it's still super early, so low probability that any of them win. But among them, I think Cosmos is probably my front runner. So we're going to take one more question, and then we're going to cut you guys loose.
All right, let's take this one.
Yeah, and I love Plasma. And I have a question back to the game because for the game in the crypto world, I think for people they used to care about how the funny game is, like how the story and like the characteristics. Does people really care about how decentralized or like because the game have the peer review, right? Like for sometimes people love this game and maybe about 10 years later people like just all forgot about this game and went to and go to another one. Like, does people really care about how the game like have their the decentralization for the whether they own their like the store or some things? I think people more curious about like how the history is like the characteristic of the people in the game.
So I think that one can be pretty much validated empirically. And you're saying, well, do people actually care about decentralization? Well, sort of if we look at actual data, looks like not that much. Way more people are playing Fortnite than are playing CryptoKeys or Hyper Dragons, and that part is fine. There are some games, a few games that matters a lot more. So stuff like I don't know, whatever involves gambling or money, that's probably your best bet for caring about decentralization. And there used to be a bunch of the best-known poker websites like PokerStars, Full Tilt, Serious, and that got shut down by the Department of Justice. And after that, a lot more people started caring about, okay, how can we build decentralized poker? Can we play that game in a way that I have control of my money? So sort of, I think it's a lot of it is either hype-driven like CryptoKitties or sort of real-world precedent-driven, where unless you were burned, you don't care, but then eventually start caring. And I don't know, another example of that is apparently Vitalik got interested in crypto because they nerfed his World of Warcraft thing or whatever. So sort of like, you don't care until you do, I guess.
I want to give a slightly different perspective on that question. Is that I gave the analogy earlier of being in World of Warcraft and having a sword and having swords inflate. But the reality that's kind of a bullshit example because the reality is nobody cares about self-sovereignty of their swords in World of Warcraft, right? It's not a problem anyone has. Nobody's clamoring for a solution to that. I think the reality of why it's interesting to put game-based assets onto a blockchain. It's kind of analogous to why it's interesting to put security tokens on a blockchain. Because security tokens, you can kind of tell the same story, right? It's like, well, they're kind of controlled by the issuer, you're still connected to the financial system, like, do people really care about this? And so far, no, right? But the interesting thing, I think, about putting game assets onto a blockchain is not about swords or items or the things themselves. It's about creating an economy around those items, right? Right now, there are games that have economies, but they're kind of crude and they're kind of like hand-tuned and they kind of have all these problems, right? And they're not really fully liquid or fluid, or and they don't connect to the real world, right? And so you have some World of Warcraft gold, and that World of Warcraft gold is worth a lot to a lot of people, right? You have some Fortnite skins, and those are worth a lot of money if you can sell them to someone. But it's really hard to sell them to someone. It's really hard to get normal money for it. All of that stuff has to be like, done impromptu over Craigslist or whatever. I don't know. They've got like, bulletin boards where they can interact with each other. There's very little liquidity in those markets, which prevents an actual fully fledged economy forming around those items, right? And if in fact you go to a world where you do work in a digital sphere that gives people value because they want the thing you made or they want the thing that you accrued, that changes your relationship with that game, right? I don't think it's obvious right now, as it is, I don't think it's obvious for security tokens either, whether changing your relationship with that game matters enough to make those games world scale interesting. I suspect probably if you connect that with gambling. But I think it remains to be seen, but that's, in my mind, the vision.
Yeah, like I still have another last one question.
Go for it. Final.
Final one, right? Okay, sorry, thank you. Yeah, this question is about, because I love your idea about how the game will be the digital asset, they can store value, this kind of thing. But it's kind of people get a consensus about the art craft. Like people bought some famous painting or some sculpture from the auctions, and they use that to sell them. They sell them, and because people have already got a consensus about the price of them, right? It's kind of like gold, like the diamond. And I have a question about how do you think people can get a consensus from the because you make the offer for the art craft is offline, it's not online things, it's not digital, and it's hard to approve it online. And how do you think people can get a consensus about the online digital asset? What do you think is the most important in this way? In this way, like the most important thing.
I can try to take this one. So that's an interesting analogy, and definitely there's some lack of parity, right, where there's only one Picasso painting, but what does it even mean to own a CryptoKitty if everybody can download the JPEG? But ultimately, Picasso is not about the sort of the value of the painting, because that could be reproduced pretty easily. It's kind of about the story that's tied to that and the social status you get from owning it. So from that perspective, if there's a CryptoKitty #1 and it got sold and resold and participated in some kind of DAI liquidation and whatever, you're not necessarily buying the JPEG. You're kind of buying the story, and everybody can track the story. So it's this purely sort of consensus-based good where okay, I'm owning that one, and sort of everybody else is buying into me being cool for owning it.
Yeah, I like that analogy. Is that why is a Picasso worth anything when I can just Google image the same picture and then print it out and put it on my wall? Yeah. Well, it is, because as humans we care about the continuity, right? It's sort of the ship of Theseus kind of thing, right? It was like, okay, well, this was the original ship that it started as, and so this ship is the one that we say is the real Picasso. In the same way, we're going to say, look, this CryptoKitty was once and forever the first CryptoKitty, and even if you create a new UI for CryptoKitties, which has your CryptoKitty as #1, it's like, well, no one likes that UI. People like the original story, and so they're going to go with the original story. If you want to be the person who owns the #1, then you gotta pay up.
I love your answer. Thank you.
Yeah, awesome. Thank you everybody for coming. Appreciate your patience. And yeah, that's all from us.
Yeah, that was way more patient than we expected. Thank you.